It's 9 a.m. live from the Nasdaq market site in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance Live. Here's your morning rundown. It is Jobs Day Eve. Expectations are solid, but economists aren't expecting the kinds of numbers that would convince the Fed to let its guard down. Jobless claims for last week rose slightly, but still signal a strong labor market. We'll get more clarity tomorrow at 8:30 a.m. Eastern time. You won't want to miss that.
Big report there. Plus, oil prices are steady after the previous session's big losses as the record highs of last week come back down to earth. Months of those highs were good news for Exxon. Crude prices bumped up the oil company's profits by around $1 billion during the third quarter.
And snack demand on the decline? Blame Ozempic, or at least Walmart is. The retailer saying that they have seen a, quote, slight change in buying habits from those taking weight loss injections. A lower appetite means less food in the shopping cart.
Well, getting back to jobless claims here, they came in lower than expected this morning with about 207,000 people filing for first-time unemployment benefits, a slight tick up from the week prior, another sign after the hot JOLTS report earlier this week that the labor market just keeps chugging. Now, of course, investors, though, anxious to see tomorrow's jobs report and to see how the hot labor market is perhaps normalizing and where it's showing some signals of normalization. And I think that's part of this larger equation that the Fed, in their dual mandate, is continuing to consider, of course, is in the labor market, and especially on wages, where you're starting to see some moderation there, particularly as we kind of get this deluge of employment situation type reports over the course of this week. JOLTS, ADP, private payrolls, and then additionally here today on the jobless claims. Perhaps that we're back into this scenario where that's the more of the pulse that we can expect on a weekly basis that can start to show us some of the cracks in the employment situation as of right now, too.
Yeah, certainly. Well, the job openings earlier this week really showed a pretty big uptick here when we talk about the fact that demand certainly, when it comes to supplies, demand certainly outweighing supply there. The question is when we're going to see the labor market come better back into balance. I think that's also obviously a big issue and one of the challenges here for the Fed in terms of trying to predict that and exactly what needs to happen in order to get more pressure on the labor market and hopefully be able to do that without inducing any sort of a recession. When it comes to this week's numbers for claims, 207,000 was an uptick, but it did come in below the expectation. And this report comes at a very critical time for the Fed. They're trying to figure out exactly what needs to be done policy-wise in order to get inflation eventually back down to that 2% target. But when you still have a tight labor market, obviously that's going to put the pressure up here on wages. That would add eventually here to inflationary pressures. So could complicate the Fed's fight to get inflation under control, and then also calling into question whether or not maybe another rate hike is needed before the end of the year. When you take a look at the CME Fed Fund futures right now, traders pricing in a 25% chance of a hike in November, around a 37%, nearly 40% chance in December. So you can see the street pretty much split as to whether or not we will see another hike before the end of the year. You
know, one data point that I would look to within this jobless claims report specifically and kind of marry it together with a broader trend, or at least a theme in that JOLTS report that we got earlier this week, even though there is more of a lag on getting that figure, is in this weekly jobless claim, the total number of continuing weeks claimed for benefits in all programs for the week ending September 16th. That was 1.6 million. That was a decrease of 57,000 from the previous week. Now, what that signals to me, at least, is that people week over week are still looking for opportunities to get back into the labor force participation here. And you think about where in the JOLTS figure for that 9.6 million openings that we saw on the last business day of August, for some of those openings to start to be filled, ultimately it's going to rely on that continuing claims figure to continue to come down and continue to decrease as well. And that's perhaps where we'll get more of a pulse on where those re-entry points are for a lot of people in the labor force participation as well.
Yeah, certainly. All right, well, let's talk a little bit more about the jobs picture right now, because the latest jobs report lands tomorrow, and the street expecting around 170,000 jobs to be added in September. Now, that would mark a slowdown from August's 187,000 number, though that's still only marginally down from pre-pandemic levels. Now, the unemployment rate is also expected to inch down to 3.7%. We'll also be keeping a close eye on wage growth, which showed signs of moderating last month. Joining us now to break it all down, we want to bring in Eric Freeman, U.S. Bank Asset Management Group Chief Investment Officer. Eric, great to see you here. So I know you guys, you were going through some of the top questions that you're getting from clients right now. And one of them is around the labor market and when you expect to see the labor market normalize. What is this number? What do the latest readings tell you about where the labor market stands?
Yeah, Sean and Brad, great to be with you. We'd say that this remains a resilient economy, and the nexus of that resilience really rests in the labor market. And whether you look at some of the claims data, obviously the ADP number, the JOLTS data, there's still some stickiness of demand for employers to find workers. It remains, especially for small businesses, a tough environment to keep people in chairs. So what we think that means is that wage growth is probably still risk to the upside as opposed to the downside. And clearly the trend has been for a slower rate of increase, which is really what the Fed wants to see. I think what has markets a little bit concerned right now is that rate of change is just not great enough. In other words, we're not seeing a significant downturn, and that's been, again, a bit inflationary. That's been some of the concerns that we've seen very persistently across markets in the current environment.
Yeah, Eric, that's a great point, and especially considering the employment situation and how that marries up with consumers, their confidence, the sentiment, or even expectations. You know, I kind of harken back to the Conference Board most recent consumer confidence reading that said the employment situation regarding this, slightly more consumers saying jobs were plentiful, also saying that they were harder to get. But we've also been looking at, especially as our own Josh Schaefer pointed out a couple days ago, the narrowing for people who are jumping jobs or going elsewhere to try and find a bump in their salaries as well. That plays into the wage picture, which also gets back into the discretionary income. So all of these things considered, typically people would have been opting for those new jobs to try and get a significant bump to outpace their costs of living or, you know, other things that they wanted to get. How is that having a larger impact on sentiment or confidence among consumers from your purview?
Yeah, those are great points, Brad. I think that the essence of it is simply this, that the low-hanging fruit of what's called the job market arbitrage, people that were going from position A to position B for a 10, 15, 20% wage increase, that is not totally done, but that's largely behind us. And I think that, you know, you've seen the ratio of job openings to job demand being at roughly 2 to 1, now down about 1.5, 1.4 to 1. So that doesn't sound like a huge difference, but that does certainly add up over time. So I think this is good progress in terms of maybe a normalization of labor market trends, but by no means are we at levels where wage growth will be subdued. So again, back to the idea of this very sticky, very persistent inflationary environment. 2% is what every central bank around the world, not every, but most central banks around the world want. We're still far away from that. Whether you look at headline inflation at, let's call it 3.25, that's obviously a gap between those levels and 2%. So I think that has the Fed's attention in terms of the need to really bring those measures down. They'd like it to happen more gradually. And again, the interest rate environment is certainly pressuring the consumer to, again, think about their spending trends as well as what they're thinking about with future employment opportunities.
So, Eric, what does all this tell us then about equities and about the stock moves that we could see between now and the end of the year? A lot of uncertainty about the Fed becoming even more aggressive, 40% chance, at least traders are pricing that in, about another rate hike before the end of the year. What do you think the S&P moves could look like between now and then?
Yeah, Shauna, we're in a really neutral position across our client portfolios right now, which is not to say that we're indecisive. We talk about this all the time. I'll give you a couple of key levels. We think S&P 4200 is really the key level for equity investors. Most of the major indices that we look at, whether it's small caps, emerging market equities, international developed equities, those are below trend. Those are not positives. The two areas that have really been stalwarts that have been hanging in there are both Nasdaq, the Composite, as well as the Nasdaq 100, plus the S&P 500. Obviously, S&P has got a huge weight to technology in it. So The last shoe to drop, if you will, may be that S&P, which again, we're not saying is going to definitively happen. We're close to that 4,200 level. We think activity, again, let's call it a thrust on good volume below 4,200. That would be really important to pay attention to. So we think the bias is probably for a little more of a sideways trading back and forth around 4,200. We do think there is probably on a 2 or 3 year view, we'd be buyers of stocks. On a 6-month view, we think that choppiness about the Fed into year end, as well as maybe the first quarter earnings expectations are a little elevated right now. So again, our viewpoint is probably sideways, so a slightly downward bias over the next quarter or so, but we'd be buyers of weakness under the current construct.
And so when we get into November and perhaps even beyond, as we think about 2024 and the number of calls that have come forward for when the Fed might cut, what they might have to see, what's your timing looking like, and what are your expectations even going into next year?
Yeah, our viewpoint, Brad, is really twofold. Number one, we think there's probably one more hike for this year. And we do think the Fed is going to stand pat higher for longer for at least another 4, 5, 6 months after the turn of the year. So I think the key consideration, I think our viewpoint would really change if the 10-year Treasury got above, let's call it 5.25 on a sustained basis. That's the equivalent of almost like the Fed as the personal trainer, keeping that inflation ramp on the treadmill just elevated for some time. In other words, one of the things we're concerned about is just how long can this economy withstand elevated interest rates. So we do think there's the bias for the Fed to do one more. We think they want to see how things play out over the course of the first and second quarter. One of the key things we'll also be paying attention to is the holiday spending trend. So the consumer is certainly still strong in a good place. One of the things we are concerned about is if they get over levered. We're seeing some more activity happening on credit cards. We're seeing an increase in delinquencies, but again, from very low levels. So we think that all that in a nutshell is this. The Fed probably has one more hike in them. They're going to wait to see how that matriculates into the economy. And then again, the hope, if you will, is that we see wages come in, we see the job market normalize, and that sort of soft landing occurs. That's our base case. But what really changes that viewpoint is a sustained move in interest rates above 5.25. That really changes the game from our perspective.
U.S. Bank Asset Management Group CIO Eric Friedman. Eric, great to kick off the morning and the trading session. Well, not quite yet, but we're about 18 minutes out. Thanks so much for starting the day with us.
Great to be with you. Thanks so much.
Thanks. Well, switching gears here, Walmart seeing a slight pullback of shoppers, but not for economic reasons. The company's U.S. CEO has told Bloomberg that they're seeing an impact on shopping demand from people taking the diabetes drugs Ozempic, Wegovy, and other appetite-suppressing medications. The retailer is saying that they're seeing the changes in anonymous shopper population data. For more on this, we've got Brooke DePalma, Yahoo Finance reporter. So Brooke, break this down for us. What is Walmart saying and the impacts that they're seeing across some of their aisles?
Yeah, good morning, Brad. Certainly one to watch, especially when America's biggest retailer is weighing in on the conversation. U.S. CEO John Furner saying in that interview that they're seeing a slight change in shopping behavior of those taking the drugs compared to the total population. Now, that change is them seeing a slight pullback in their size of baskets. They're buying less units and ultimately slightly less calorie options. But it is important to note here that they also said that it is too early to draw any definite conclusions about the drug, but we do know that Walmart is getting a boost from these sort of drugs. In the company's earnings report, Walmart CEO Doug McMillon weighing in say that they still expect food, consumables, and health and wellness, primarily due to the popularity of some GLP-1 drugs, to grow as a percent of total in the back half. And in the past few years, we've seen the momentum build around these weight loss drugs on a bigger scale. The U.S. sales for medicines like these increased 300% between 2020 and 2022. Now, that's pretty incredible to think that this year alone is when we've really started to hear about it. And so we'll wait to see what that number is for 2023. But of course, we've heard from so many celebrities getting into the conversation. And so this will be one we'll continue to watch.
It's going to be one we're going to continue to watch here, Brooke. And we know that Walmart isn't the only company watching and talking about Ozempic and how weight loss drugs could potentially be affecting their margins. What else are we learning about some of their competitors within the space?
Yeah, Shauna. Well, many of the food brands inside a Walmart are also thinking about this very heavily, I'm sure, in their boardrooms and beyond. And Wall Street really trying to wrap their head around the scope of what exactly this means for food and snacking brands. So many saying that, these companies that consumers go to maybe snack on more than 3 times a day, like a Hershey's, like a Mondelez, like a Hostess, which was recently acquired by Smucker's, as well as Goldfish's parent company, Campbell. They're ones to watch about the potential impact of these drugs. Bernstein also out with a note about the potential impact on alcohol consumption. They said that they still need to know an awful lot more, but 2 potential threats include the side effect of consumption of alcohol to reduce weight, as well as the potential for even greater reduction in consumption if these drugs are actively used to control alcohol consumption. But once again, it's important to note here that we're still in the early innings. In more than a decade, by 2025, there is an expectation that nearly 7% of the U.S. population will be on these type of weight loss drugs. But right now, there is a shortage of these weight loss drugs. It is still intended for type 2 diabetes patients, and we've seen employers and insurance pull back on providing these. And so there's still lots more to learn about the impact of these drugs on consumption behavior, and in addition to just sort of what exposure and what supply we'll have of these weight loss drugs as well.
And also the potential side effects of these weight loss drugs, clearly a focus here for many Americans as well. Brooke DePalma, thanks. Well, we've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance. I'm Shauna Smith alongside Brad Smith at the Nasdaq market site. We're just about 10 minutes until the opening bell. Jared Blicker has a close look here at some of the movement that we're seeing in the pre-market, Jared.
Yeah, so a little bit of downside action, as you can see in the U.S. I brought up the KOSPI yesterday because it's an important global barometer, and this is a 5-day price action. Guess what? We are lower for another day. This is the overnight. What happened? You can see all of those gains were given up by the end of the session, and I think that's leading to some of the risk-off flavor that we saw in Europe, and then eventually propagate into the U.S. Here is the sector action for today, and energy just taking another hit. It was down 3.14% yesterday, down another 1.2% in the pre-market. I'm just going to track XLE on a year-to-date basis, and I think it's going to be more interesting if we go over to the crude oil market. We just had that OPEC Plus decision that basically reaffirmed the existing cuts, 1.3 million, 1 million by Saudi Arabia, and then another 300,000 by Russia. Here we go. Here's crude oil. WTI now with an 83 handle. It was only a few days ago that we were all the way up to 95, so that's more than $10 downside price action. And if I show you a 2-year chart, you're going to see we had this base and we broke out of it, and now we are coming back down. We are just testing that breakout point. So this is kind of do or die for the next leg in WTI crude. We can go up or down materially from here, and we know that translates into all kinds of other markets downstream. Natural gas, as long as I'm looking at futures, that's up 3%. But let me get into some of our heat maps here. Here's energy, and I'm going to put the pre-market quotes back in there. A lot of red, not only from yesterday, but also overnight. Exxon down 3.74% yesterday, down another 1.6% this morning. A little guidance in the pre-market for its earnings, not enough to move the needle for it. And now banking, we're seeing some green from yesterday, but overall mostly downside. Just getting back to the sector action one more time, probably going to see a lot of red on the open. But with the S&P 500, as long as it stays above 4,200, to echo the points of a prior guest, probably in the clear here. But 4,200, a do or die point for the S&P.
All right, Jared, excellent breakdown ahead of the bell. We've got about 7 minutes till that point. Stay with us for the opening bell, Jared. We've got much more to discuss at that opening cross. In the meantime, let's talk about beer. Beer is the big winner from Constellation Brands' second quarter results. The owner of Modelo and Corona brands raised its guidance for fiscal 2024 with its beer portfolio posting 12% sales growth. So hold on, where are all the wine drinkers? Joining us now, perhaps one of them, Bill Kirk, Roth Capital Partners Senior Research Analyst. Bill, I don't want to falsely report whether or not you're a wine aficionado or, a grand sommelier, but all that considered here, what's your takeaway, the big breakdown here from Constellation Brands, and where particularly does this kind of lean into your own evaluation of the company?
Yeah, I mean, I think your intro was completely right. So you saw the consolidated operational beat despite the softness in wine. So wine shipments were down in the mid-teens, wine depletions down about 9%. And yet here's a company that is able to raise guidance on the strength of Modelo, on the strength of Corona, and on the strength of Pacifico. What you have here is a consumer staples company that's accelerating through the year, and that's a bit rare within this broader segment. 2Q here for them was better than 1Q. 3Q should again be better than 2Q, and that is on both top line shipments for beer and for beer profitability.
Well, digging into that a little bit more here, Bill, because when you take a look at some of the momentum that we saw from the quarter, some of that being attributed to the benefits that Constellation, that the Modelo brand has seen from the boycott of Bud Light. When we talk about the stickiness of that consumer and the market share gain, what's your read on that?
We think it's going to be very sticky. So these results of beer accelerating happened before retailers are resetting their shelf space. So right now in the fall, retailers are allocating more space to Constellation's product, and they're taking space away from Bud Light. And so what we think that does is twofold. It reduces any sort of out of stocks, right? Just the more product you have on the shelf, the less likely you're to be out on a big weekend. And it increases advertising, right? If you're looking for a brand, it's much easier to find it if the shelf space is greater. So that happened, after this quarter's period, and that's part of what becomes the stickiness of the product. So that is happening in a larger amount on a go-forward basis than it even has so far today.
Bill, we had seen some of the major beer manufacturers really seek to capitalize off a change either in taste or preference following the issues that Bud Light had run into over the summer and earlier this year. Is that something that is still at play here from what you're seeing in these results from Constellation Brands?
Yeah, so the demographics are squarely in their favor. People want lighter, more refreshing beers, especially during the summer months of this reported period, and they play directly into that tailwind. So Modelo trends are plus 9%, and that's in a beer industry that is struggling to grow. The beer industry is declining, and here you have one of the biggest beer brands in the United States, the biggest beer brand over the summer, nearly still growing double digits. So they are squarely in growth trajectory. Their focus is on those core three brands, Modelo, Corona, and Pacifico. And so that's where you're going to see the marketing. That's where you're going to see the innovation attention. And that's where you're going to see the resources appropriately attributed.
So are we to believe, because this is, to your point, in marketing spend, a company that has leaned into big partnerships with those like Snoop Dogg. Is Snoop Dogg paying off, from what you're saying, for Constellation Brands here?
So their marketing is world class, and part of the beauty of it is they got it right so long ago. Right, that Corona messaging has not changed in a long time. It's resonated, so why mess with it too much, right? You can tinker with it with Snoop Dogg, or you can tinker with it with Andy Samberg, but it's basically the same message it has been for a long time. Modelo also, going back almost 8-10 years now, has been basically the same marketing message the whole time: the fighting spirit, the everyday consumer, and that's makes it a lot easier to implement ad campaigns when you don't have to refine your message. And they don't have to refine their message simply because it's working, right? With how well they're growing, they don't have to do anything too dramatic. They can kind of stay in this precise marketing lane, which has been good for a very long time.
Bill, when we talk about the risk of a recession, how alcohol sales are going to hold up if we do see a larger pullback, what do you see that's ahead here for Constellation? And also, more specifically, when it comes to the wine business, one of the weaker parts of this report, are you confident that we'll see a turnaround there?
So the two best beer volume years in the last, say, 20 were the Great Financial Crisis. So the best two beer volume years were basically 2008, 2009. So beer holds up very well, and it's because there's kind of a natural trade down. If you want to spend less on beer, you can without forfeiting any six packs. You can just drink less at restaurants, drink more at home, you save money and can drink the same amount of beer. So they have a natural trade down kind of protection built in. On the wine side, that is a little bit more discretionary. That is a little bit more higher price point on premise. And that's where some of the struggles have been. So I don't have a lot of confidence wine's going to improve, but it's only about 8% of the company's profits. So I do think wine struggles continue. I do think the trade has too much wine inventory, and the consumer, if they tighten, has a little bit of a wine price point avoidance.
All right, well, despite the beat, Constellation Brands under a bit of pressure here this morning. Bill Kirk, Roth Capital Partners, a senior research analyst. Thanks.
Thank you.
Well, it's the opening bell on Wall Street. We want to do a quick check of the markets, taking a look at some of the pressure that we're seeing across the board. All three of the major averages. It looks like it's starting the day lower here. The Dow under just a bit of pressure. Jared Blickery at the big board for us. Jared, what are you watching?
Well, I'm looking at the Nasdaq, and I'm seeing a mixed board, as you can see here. Not a lot of dark red or green, and that just means that we're not seeing any outsized movements to the upside or the downside. It looks like Rivian here. Let's see what's going on there. Not minus 10%, down 2.5% over the last 2 days. Interesting tick there. We'll look into that in a little bit, or at least I will. Here are the sectors, and you can see only 3 in the green, and just by a little bit. We got healthcare, that's XLV, followed by tech, and then real estate. But to the downside, energy. We just took a look at crude oil, WTI with an 83 handle. Energy leading down 0.9%. And then we have utilities, which have just been decimated recently, changing spots, a lot of movement there on the bottom row. But financial staples, retail, and utilities all looking like they're moving to the downside. Now, here is our leaders in sentiment look, and we can see meme stocks up 3%. And so that's kind of a fringe area. I'll take a look at that board in a second. Then we have New York FANG, that's mega cap heavy. Then we have Byto, that is an ETF that tracks the crypto, Bitcoin market, cannabis, and some others on the top row there. To the downside, oil services, those smaller players, that's PSCE. IPO is not getting any love, and neither is gambling. But I promised the meme stocks, and let's take a look at that right now. And we can see, not seeing where any of this strength to the upside could be coming from. Meme itself is up 3%, but most of these names just kind of treading water here. American Airlines, former meme stock a long time ago, that's up 1.65%. Let's take a look inside the tech market here. I'm going to take a look at software and then chip stocks. Snowflake up 1.5%. That's the only dark green square that I'm seeing right behind me. Nothing really in dark red. And then when we look at the semiconductor, the chip space, a different picture here, much more cyclical than software. This tends to get higher highs and higher lows, but we're seeing Taiwan Semi up about 1%, NVIDIA up 0.5%, ASML, for its part, down a bit, and AMD is down 1%. But just thinking of the AI trade here, I'm going to take a quick look at NVIDIA, which has been treading water since its last earnings report. And by the way, we are in, I think we kick off next week with JP Morgan. We are in an earnings buyback blackout, so that bid is lost right now. And I think the market, after Friday, tomorrow morning, not thinking too much ahead, we're going to be concentrating on earnings over the next couple of weeks, guys.
All right, Jared, thanks so much for breaking down some of the activity at the open this morning. Appreciate it. Let's also take a look at some of the market movers this morning here. We got to start with Clorox shares. They are in decline today by about 4% out of the gate. The company announcing this week that its sales and profit took a big hit during the quarter, ending September 30th. That was because of a cyber attack that it said, and it expects net sales to decrease between 23% and 28%, and gross margin to be down from the year ago period. It expects a per share loss of 35 to 75 cents. Officials saying that they suspect Scattered Spider to be responsible for the cyber attack. The group also tied to the recent attacks on Caesars and MGM Resorts. That's according to a report by Bloomberg here. But most notably here, the figures that they had to come out, give a preliminary Q1 financial operations update as well here for Clorox, and that is what's sending shares lower here this morning.
Yeah, certainly. I think there's lots of questions just about what this means for Clorox's business going forward, and also the pressure that this is going to be on CEO Linda Rendell, because we know that she certainly was thought of as a leader that could potentially transform the company, hopefully return the company to growth. We certainly saw that during the pandemic, but Clorox has really struggled to regain some of that momentum, and some of those issues were raised in a note out from Evercore earlier today, drawing attention to the fact that Rendell lacked some of the knowledge just about the severity of the cyber attack when asked about it a couple of weeks after it occurred. So raising some questions about the leadership there, and also just more broadly, some of the pressures that Clorox can see on its business when we talk about the fact that this is really a pivotal moment for the company. They're trying to get back to where they were in the middle of the pandemic. 2020 was when we were at the high there. The shares are off more than $100 from where it was trading in August of 2020. So when we take into account some of those risks there, what it means for potential demand destruction, when we talk about higher prices, what it means for the pressure on margins here going forward, certainly a lot of questions being raised. And then also maybe we could see some interest or some activity when it comes to an activist investor showing interest in Clorox, because we know we certainly have seen an uptick of that, a pretty dramatic uptick of that over the last year or two.
Absolutely here. And for those activists, they've got plenty of food for thought here and for conversation. In this operational update, it's clear what's unclear. It's unclear that the company is, as they're trying to begin this process of transitioning back to automated order processing, and the vast majority of orders now taking place in the automated manner, they are still looking across how this cybersecurity attack not only was recognized, but also trying to figure out how it's fully been contained, and the company making progress in still trying to restore systems and operations. And so on September 25th, it sounds like they were able to begin that process of transitioning back to that automated order processing. But again, this is a significant impact, at least in the near term, and investors are going to be watching closely to see what the company has to say when they do report earnings as well for the quarter in full beyond this business update here.
All right, let's shift gears a bit and talk about EV maker Rivian, because those shares on the move this morning. Now the move coming after the company saying that sales in the current quarter would be slightly lower than expected. We're looking at a loss of just about 13%. Now they also said that they would issue $1.5 billion in convertible notes, debt that can be turned into shares, which has the potential to dilute holdings of current owners. Bittersweet, though, week for the company. Now, Rivian beating their quarterly delivery estimates. So I guess some signs of some relief here, at least earlier in the week for Rivian. But obviously, lots of questions just about the path forward for this company, what exactly that's going to look like. When we talk about the cash burn rate of the company, whether or not they would potentially need to raise more capital, even though they do say that liquidity is sufficient through 2025. I think that's one of the worries, one of the risks that the street is viewing when it comes to Rivian. Truist coming in saying that they actually see this as an increasingly positive setup into the third quarter print, just in terms of what we could see here from Rivian in the coming weeks. But you see a loss of 13% on shares today, so certainly there's still a lot of worry out there.
Yeah, and this coming the same week that we had just got some of those delivery production numbers for Rivian that we'll hear once again when they fully report earnings. But for the quarter ending September 30th, they had produced 16,304 vehicles at that manufacturing facility in Normal, Illinois, delivering 15,000 and a half of those, just a little bit more of that over the same period. So all of this said, that's roughly in line with expectations from what the company has said. We're going to be looking out for earnings to come on November 7th after the market close, but it's really just about making sure that they do have that liquidity, to your point, to be able to continue to produce these vehicles. And of course, for Rivian, I don't know, I've seen more of them around New York, more than...
That is true.
Yeah, there's a few of the facilities, and of course the model now that many of the car manufacturers, especially in the electric vehicle landscape, and really disrupted by the way Tesla goes to market and how they entered into the market as well. It's just basically a shop, like a storefront, basically, where they've got a bunch of these lined up. It's not your traditional dealership where you walk in and you see about 15 different models, and then they've got about 1,000 of them downstairs somewhere or even on a lot. This is different, and I think that for that experience, it's been fascinating to see where they can go more outside of just this dealership model that many of the legacy automakers have powered for decades at this point as well.
Yeah. Many of their models, though, they're pretty expensive.
They are pretty expensive,
Just one of the
yes
headlines
indeed. Pretty penny. Let's go to our next mover, BlackBerry. We're tracking those shares, and they are on the move today, down by about 1.8%. This comes after the company plans to hold an IPO for the company's Internet of Things division, splitting it from the company's main cybersecurity business. The Internet of Things division is focused on putting online capabilities and sensors into appliances, cars, and everyday items here of very miscellaneous sort. But anyway, the split is expected to happen in the first half of the next fiscal year. This is a considerably different BlackBerry than what we grew up on. I can't even say it's not your grandfather's BlackBerry, because it's not our BlackBerry that we had in college even, or in high school, or for many of us perhaps had those little clips on the side of our hips that we were walking around with. This is different BlackBerry, more Internet of Things, more cybersecurity, more trying to get into the auto vehicle experience as well here. And so it'll be interesting to see what type of market reception for at least this part of the business they're able to see in an IPO.
Yeah, CEO John Chen saying that this new proposed structure is going to further increase both their operational agility and also their ability to focus on delivering what he's calling exceptional solutions. But in terms of this leaner structure and the fact that BlackBerry at least sees this move as a way to help investors better evaluate their two different business divisions or two separate businesses, this is a move that we have seen from many companies, or a handful of companies really, over the last several months, over the last couple of years. When you take a look at Kellogg and what happened there earlier this week, Johnson & Johnson recently, General Electric, GE, there certainly has been a move to spin off parts of their business, saying that it is going to increase shareholder value, will let shareholders better evaluate the company going forward. But certainly I think a lot of people are still trying to figure out exactly what it is that BlackBerry does these days, right? Because it's still tied mostly to the phone business, even though it moved away from that years ago, focusing on Internet of Things, focusing on cybersecurity. So I think this move here might further really help shareholders better value the company and give it more of a focus on its two leaner structures.
It's a reinvention story for sure.
It is a reinvention story that's still underway, but shares of BlackBerry there under pressure this morning. We've got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Have you tried pickleball yet?
I haven't. Someone gave me a single paddle, which I gave to my 7-year-old who loves it, and so now I apparently have to buy some more.
Done deal. All right. Getting the whole household involved. Love it.
Instacart shares have underwhelmed since its IPO, now sitting about 9% below its listing price. And our next guest is warning of a tougher road ahead amid an increase in competition. Here to discuss all that, we want to bring in Bernie McTernan. He's at Needham & Company's senior analyst. So, Bernie, you're one of the first analysts on the street to initiate coverage on Instacart. You've got a hold rating on the stock. What are some of the biggest issues that you see ahead for the company?
Yeah, and thanks for having me on. And so I would outline two things. First is just the TAM. And so we model 125 basis points of TAM expansion per year. That's after the pandemic. Online grocery in the U.S. went from 3% of grocery sales to 12%. But we really think the risk skews to the downside, where you could have 50 to 75 basis points per year. So that would make the industry a high single-digit grower versus a teens grower that we have in our base case. And then secondly would be competition. And so Uber and DoorDash really just launched online grocery delivery during the summer of 2020, really rushed to get that product forward during the pandemic. They didn't strike a deal with Albertsons until 2021. Uber is going to have some integration with Corner Shop coming here in the fourth quarter. So it's still early days for those two companies with their products. So Instacart has a decade-long head start, and we think over time that product gap should be able to be competed downward, and that's going to create a difficult situation for Instacart in our view.
How does the take rate compare on Instacart versus some of those other competitors that you were just mentioning, Bernie?
Yeah, well, so Instacart has it matters what the AOV is or what the average order value is. One of the interesting things that we did in our analysis was looking at kind of four quadrants: one, subscribers and non-subscribers on one axis, and then a $35 order and a $150 order. And what we saw is that Instacart's actually not the cheapest in any of those categories. And so over time, we think price certainly matters. We did a consumer survey asking consumers what drives them to use their favorite delivery order, and certainly price matters. And so I think that's going to be important over time. And so we think that's why Uber and DoorDash are in a better position competitively.
Bernie, beyond price, that's interesting there, just in terms of what determines app use. What else did you find from that survey?
Yeah, I would say going back to the TAM discussion, so 3 major reasons why consumers don't do online grocery, and 2 of them we think are structural. So 1 is just if it's too expensive, but then 2, quality concerns issues. So making sure that you're getting the right protein, or you're getting the right avocado, if it's ripe or not ripe. And then 3 is people actually like going to the grocery store, and we think those last 2 reasons are certainly structural. And so while we think about where that 12% of online grocery sales could go, we think that there's structural impediments for why it won't get to online restaurant order levels of digital penetration.
And so in that penetration, as our viewers are taking a look at it right now, or at least they were on the screen a moment ago, when you think about how in that total addressable market you need to see other expansion internationally, what regions are they already having a leg up against some of those other services, either locally or the ones that are also international players?
Well, Instacart's solely focused on the U.S. right now. I think that there is a larger there could be an international opportunity for them over time. But no, they're solely focused on the U.S. market right now. I mean, the other market that we're talking about just online grocery right now, but what comes with that is really the advertising opportunity. And that's one area of the business where we have been bullish in them as a retail media network. So that's them why it's so attractive for advertisers, especially CPG advertisers who are spending over $200 billion per year on advertising, is that advertisement happens the same place where the purchase happens. So think about that attribution that you're able to get as an advertiser. The only difficulty for Instacart, and as they've grown this business to almost $1 billion, I think they can get to 4 to 5% investment rate over time. The difficulty is that you are competing with grocers with that online to offline channel, and grocers, right now their gross margins are right now about 20-25%. Their EBIT margins are mid-single digits, and one of the reasons why they're even that high is because of advertising dollars. So we think there's the potential for that relationship between Instacart and grocers to be strained over time, as Instacart's increasingly competing for those same advertising dollars.
Bernie, Instacart has some tough decisions to make when we talk about growth versus profitability. How do you see Instacart balancing that, given the importance that investors, that shareholders are placing on profitability amid the broader economic environment?
Yeah, and so profitability right now is one of the good parts of the Instacart story. They've had a $1.1 billion swing in EBITDA from 2019 to what we expect in 2023. So a huge turnaround. And one of the things that really happened was that in 2021, when they really got this order volume surging, in the start of the pandemic to mid-pandemic, is that they really said the unit economics of the business really started working. And so think about, once you get to a certain scale, and it's really local scale that matters, because then a shopper at a particular grocery store can be batching multiple orders at once. And so that way, even though the shopper is collecting multiple tips during that hour, Instacart doesn't need to pay them as much for their time, or they would if they were just completing one order at a time. So that's why competition really matters. And so, again, that's why we mentioned in terms of the pricing with the services, in general, our view is that profitability, that there's risk that their current profit margins could be competed away over time, from an Uber and a DoorDash. And frankly, we've talked a lot about competition, haven't even mentioned Amazon yet. And so usually when you're talking about, an area of the market that has over $1 trillion of consumer spending that Amazon squarely has their tentacles in, that's certainly a high risk as well.
Bernie McTernan, who is the Needham & Company Senior Analyst. Bernie, always a pleasure to speak with you, especially about one of the tastier parts of the market out here. Thanks so much.
Thanks for having me.
Definitely. All your markets action straight ahead, live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. Welcome back, everyone. You're watching Yahoo Finance Live. We're live from the Nasdaq market site in Times Square. Lawmakers have until mid-November to reach a deal to keep the government open. And without a speaker at the helm, the House can't move forward on any spending bills. Rating agency Moody's previously warned that a government shutdown could put pressure on the U.S.'s credit. Yahoo Finance's Rick Newman joins us now with why a credit downgrade is still worth keeping on your radar. Hey, Rick.
Hey, guys. Well, first of all, it seems possibly more likely than before that we are going to have a government shutdown in November. The political analysts I've been following on this say it's very hard to see how Congress is going to get all the bills finished that need to fund the government. Remember, the House at the moment is basically not functioning. And even if it does get a speaker, all the dynamics that we saw leading up to the chaos of the last week are likely to remain in place. And Moody's has already warned that if there is a government shutdown, it could be the third rating agency to lower the U.S. credit rating from the AAA level, the best there is, that the United States has enjoyed for most of its history until recent times. And all of the, so Standard & Poor's has downgraded the United States. That went all the way back to 2011. Fitch downgraded the United States earlier this year. And the problem is not the creditworthiness of the U.S. government. All of these rating agencies keep pointing out the problem is political. It's that lawmakers and policymakers simply cannot run the country in a coherent fashion, and this almost always lands on Republicans. It is Republicans who are the ones who are threatening not to pay, $33 trillion in U.S. debt. It's Republicans who are always doing the shutdown theatrics. And this is starting to matter. I mean, this rise in interest rates and bond rates that we've been talking about during the last several weeks are related to the size of the U.S. debt and to probably related to this situation with the credit rating of the United States. And it's beginning to look like you can say that higher interest rates, which are costing Americans money through more expensive mortgages, car loans, and so on, part of that is because of these idiots in Washington. So these politicians who cannot get the job done, almost all of them Republicans, are starting to cost ordinary people money, and we need to turn this around.
Rick, talk about a little bit more about what this exactly could mean for investors, because I think a lot of people largely brushed it off just in terms of the risks there. But if we do see a government shutdown, if we do see a downgrade here in the credit rating, just what the possible implications of that are.
It does not have direct implications for most things investors care about. I mean, it's not like the stock market is going to tank the day after Moody's becomes the third rating agency to lower the U.S. credit rating. But everybody is now talking about what's happening in the bond market. And the bond market does not announce why interest rates are going up exactly, but it's very clear that we are seeing interest rates going up no longer because the Federal Reserve is pushing short-term rates up. Interest rates are going up, medium and long-term rates are going up for other reasons. And it's probably not one simple thing. We do not know if this is sort of permanent, temporary, what's going on, but it is probably the case. And, you're just starting to hear people trying to figure this out. It's probably the case that high levels of U.S. Public debt and the political problems in Washington that could lead to another downgrade are part of the reason that medium and long-term interest rates are going up. Again, this is the mortgages. We've got mortgages now over 7%. We have had medium and long-term rates going up by more than short-term rates for the last several months. So it's not the Fed anymore. It is other factors that are affecting the bond market. And it does seem like the so-called bond market vigilantes who have been asleep for the last 20 years are starting to wake up.
They are starting to wake up. All right, Rick, always great to get your insight. Thanks.
Bye, guys.
We got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Welcome back. You're watching Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith at the Nasdaq market site in New York City. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Stocks are falling today as the initial jobless claims remain near historic lows, with 207,000 people filing for unemployment benefits. That's a slight uptick from the week prior, but below consensus expectations. We're also seeing Treasury yields and oil falling today.
And taking a look at some of the individual movers, Overstock climbing higher today after the company added Marcus Lemonis. He is known as the business turnaround king to its board of directors. Now, Lemonis then picked up 33,000 shares of Overstock, showing that he's pretty invested in the business.
And we also have our eyes on Exxon. Shares of the company moving lower by about 1.7% after the company revealed in a regulatory filing that it expects to see up to $1.3 billion more in profits compared to its prior quarter. This is thanks to rising crude oil prices. Rising gas prices will also give them a bump of about $400 million.
And we are watching United Wholesale Mortgage shares rising this morning after BTIG upgraded the stock to buy from neutral with a $6 price target. Now, the nation's largest home mortgage lender has seen some upside this year as higher rates and limited inventory keep the housing market hot in some ways. All right, well, the only thing that can stem the sell-off in the bond market is for equities to crash. That's according to Barclays. Now, analysts writing in a note that there is no level for yields to reach that will automatically draw buyers in for a bond rally, saying, quote, in the short term, we can think of one scenario where bonds rally materially, and that is if risk assets fall sharply in the coming weeks. More insight on this, we want to bring in Yahoo Finance reporter Josh Schaefer. And Josh, your biggest takeaways from this note?
Yeah, Sean, I mean, really what you were just referencing there is a little bit of what we call a flight to safety, right? So you would see investors move to bonds out of those risk assets, and there's a couple things that can cause that. You mentioned maybe a market sell-off could cause that, or even just stocks moving lower. There are plenty of calls out there right now still to just see the S&P 500, at least in the short term, move a little bit lower, maybe even below that 4,200 level, again, in the near term. That could push people to bonds. The other thing you're looking at on your screen right now, weaker economic data. We know if we were going into a recession, bonds would normally become more of a popular play. And we saw even yesterday, very, very small sample size, but we saw weak jobs data, weak labor data, and we did see yields come down a little bit. So that will be something to watch when we look forward to tomorrow and that jobs report. What does weak data do to yields? Does weak data actually bring down that yield, which could in long term eventually help stocks? But then also we're talking about a slowing economy, which isn't necessarily great for stocks either in the long run. So I think the biggest takeaway that Barclays had here was there isn't a lot good to look at when we think about how high yields are right now, at least in the short term. That seems to be the broadest takeaway here, is no one really has a great answer for when we're going to see those yields come down significantly.
All right, Josh, thanks so much for the analysis, helping us break that down this morning. Also, turmoil in the House of Representatives is what we're tracking. Congress is in recess following the ouster of Kevin McCarthy as Speaker. And when they are back in session next week, they will only have about 30 days to elect a new Speaker and pass a spending bill before the government shuts down. So what can we expect to happen next? Here with some of the insight into the situation, we've got Joseph Zeballos-Roig, who is the Semaphore congressional reporter. Great to have you here with us. Help us break this down. So the timing here, especially as it all comes together, I mean, we've essentially just kicked the can down the road to pass a bill for spending, which it still doesn't seem like on that front there is any form of unity that will come forward. And then you have in-party fighting. So what is the average American to think about the state inside of the Beltway at this point?
Well, I think it's fair to say that the state of the Beltway right now is very messy and chaotic, particularly in the House of Representatives. As we saw earlier this week, Speaker Kevin McCarthy became the first Speaker of the House to be deposed by members of his own party. This is an endeavor led by Matt Gaetz and a band of hardline conservatives. The legislative business in the House right now is essentially frozen. They can't pass bills. They can conduct very minimum legislative business. And until they elect a new speaker, I think the odds of a government shutdown are going to rise. That recently we just saw before McCarthy was overthrown, that he passed a short-term funding bill that keeps the government open until November 17th. So that means that around, mid-November, we have to repeat this cycle all over again. And if the House hasn't elected a new speaker by then I think that the U.S. government can be in a lot of trouble.
Joseph, even if the House is able to elect a new speaker, given the fact that there was such a divide, given the fact that McCarthy obviously had an extremely tough time averting the shutdown just a few days ago, what are the odds, even if we do get a speaker before then?
I think that's really up in the air right now. I think there's already some speculation among House Republicans that I've talked to that Patrick McHenry, who is a current speaker pro tempore, basically his main responsibility is overseeing the election of a new speaker. He might have to be in that role for a lot longer if Republicans can't coalesce around a new leader. And I think that, there's a lot of divides over reforming some of the rules that led to McCarthy's ouster. Conservatives, for example, want to keep the motion to vacate, which is a procedural tool they use to kick out McCarthy at the similar one-person threshold. Moderates who are aghast at what just happened and they want to restore some semblance of order in the House, they actually want to raise that threshold, and they're making a condition for their vote. So I think that we are going to be probably in for a messy speakers fight. There's a candidate forum on Tuesday, and the speakership election is supposed to be held on Wednesday. But I think color me skeptical they'll be able to quickly coalesce around a new speaker that can get 218 Republican votes at this moment.
Who is the front runner at this point?
I think there are two front runners at the moment. One of them is Jim Jordan, who is currently the chair of the Judiciary Committee with a lot of power over the current impeachment inquiry over Biden. And then the second is Steve Scalise, who is was McCarthy's number two, his lieutenant, the second-ranked House Republican. And, recently Scalise has been viewed as a natural successor among House Republicans. He has plenty of support among conservatives. He does have some drawbacks, though. Some of the hardliners who really detested McCarthy on a personal level, they're probably likely to view Scalise as representative of that toxic GOP leadership structure they want to get rid of. And then when it comes to Jim Jordan, one of his drawbacks is that, he is very much in Trump's camp. He sticks to pro-Trump talking points, and he voted to overturn the 2020 presidential election. So I think it's fair to say there that moderates are going to be reluctant to support somebody who they think that could be easily demonized by Democrats, particularly going into the next year's election.
Joseph, speaking of next year's election, talking about the future of the Republican Party, what some of this chaos signals and how that's going to be received by Americans. How do you think Americans are looking at what's playing out down in D.C. right now and what it tells us about 2024?
Yeah, so I had an interesting conversation recently with Senator Kevin Cramer, GOP senator from North Dakota, and I asked him this very question. And I think he had a really interesting perspective on it, that, what we're seeing in the House, for example, just kind of emblematic of the growing current of anger within GOP politics. We're seeing like the Republican base demand more and more from their elected leaders that sometimes may not be realistic because, their leaders still have to reach across the aisle and work with Democrats to get things done. So at least, when it comes to like the House representatives, House Republicans are getting more and more unruly, particularly when they're under the sway of a small band of conservatives that have a lot of influence over the direction of the party. And I think there's a lot of Republicans who are, really alarmed and worried about what message does this send to voters, particularly when they're trying to cast themselves as a party who's, able to govern, get inflation under control, oust Biden in the next year's election. And I think that they're worried that this sends like the wrong message to voters, that they can't, there's too chaotic. They can't be trusted to govern.
And so what does that give us, if anything, about what the inclination of the party would be on an economic front, what the plan would be, what the agenda would be that is ultimately not just campaigned on, but ultimately enacted if there was any significant changeover among the people who were at the top of that Republican Party, and then even more so for the kind of moderates within that party as well who have pointed back to Reaganism, even as we had our own conversation with primary candidate, former Vice President Mike Pence, just last week, and his calls for more Reaganomics. What does that spell out for any type of economic plan if we were to see a massive shift more towards some of the hard right?
These are all very interesting questions. And at least in the context of the speaker's race, Jim Jordan, Steve Scalise, they're very much in the traditional conservative camp. They're likely to stick to McCarthy's, McCarthy backed out of his deal with President Biden on the debt limit law. And, any elected speaker at this point, I think, is likely to seek dramatic spending cuts in these funding bills. They're supposed to, keep the government funded, drastic cuts to safety net programs, nutrition, rural aid. I think they're likely to put Republicans on a course of austerity in the House. But, I think going into next year, the likeliest candidate at this point to emerge out of the Republican presidential primary is Donald Trump. And he's shown relatively little commitment to any economic ideology. He sometimes, pushed relief checks to Americans during the pandemic, and he's tended to favor, at times large social benefits. That would put him on a collision course with members of his own party, depending on who comes out ahead in the House. So I think it's, a lot of this still has to be borne out. The dramas in the speaker's race, and then what we're seeing in the Republican primary. But I think it's fair to say that, we're going to be dealing with, a lot of things going into, early 2025. There's a lot of tax cuts that need to be renegotiated, some healthcare insurance subsidies that Democrats are going to want renewed. So it's going to be likely, at least from a policy standpoint, that, there's going to be potentially another round of tax cuts in 2025, because that was the point of the Republican tax law. Some of them are sunsetting, and I think President Trump and anybody in the Republican primaries expressed interest in preserving them.
Certainly, we will see how this all plays out. Just about 13 months to go until Election Day. Joseph, always great to have you. Thanks.
Thanks for having me on.
We got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Stocks have been struggling to shake off the downbeat move that's increasingly hanging over markets. There's a new survey out from KPMG that found that CEOs remain confident with the overall growth of the economy in the long term, but they're not necessarily optimistic when it comes to their own company's growth. Let's talk about that and more. We want to bring in Paul Knopf. He's a KPMG U.S. Chair and CEO. Paul, it's great to have you here on Yahoo Finance again. So let's talk about what you're hearing from CEOs. You talked to hundreds of chief executives just about their outlook right now. What did you learn?
Well, I think, first of all, we're getting more clarity on the duration of what we're facing into. So more clarity around the fact that rates are likely to be higher longer. And also, undoubtedly, inflation is going to be sticky. So inflationary pressures on food costs, on energy costs, certainly on labor costs are going to persist, it feels. So I think that's what's maybe causing some of the subdued confidence of CEOs for growth prospects going forward. And we also see, though, that CEOs are still wanting to put as their top priority generative AI. So 72% of CEOs said that that was their top investment priority, continue to invest in their ESG strategies. And interestingly, although market conditions need to stabilize, 54% of CEOs said they're interested in transformational growth for the future, largely through inorganic M&A.
Does subdued confidence for growth, does that translate into additional restructuring? Are we looking at another wave of headcount reductions, which we had thought we'd gotten behind us to this point?
No, not necessarily, because I think that if you look at the overall data, 77% of CEOs are still confident about the growth prospects of their companies over the next 3 years. So there's a lot of resilience and there's a lot of confidence in the business models CEOs have. I think we're all just trying to determine, how do we navigate higher for longer interest rates? How do we deal with uncertainties around inflation outlook? And that is causing us to dust off playbooks we haven't used for 20 or 30 years to try to ensure we know how to operate in that kind of environment.
Are majority of CEOs, are they bracing for a recession? I guess, how has maybe the last couple of months and the fact that we have seen the surge in energy prices recently, how that's playing into the recession probability?
Yes, I think for the last 12 to 18 months, we've all been trying to prognosticate whether a recession is coming or not. And if you'd asked me 6 months ago, I would have predicted probably not. I think there's a little less clarity on that right now. I think if there is one, the duration should be fairly short and not overly severe. But I do believe that there's still a lot of fog on the horizon, and it's really hard to know whether a recession will hit. Now, what I would say, though, is that we probably have had many kind of sector-based recessions that affect various types of industries over the last 2 years. But the probability of an overall recession for the U.S. economy is still hard to predict.
You mentioned the spending into AI. What do CEOs right now look at as the barometer for whether or not their AI investments are actually paying off?
Well, I think that we have to all realize that the investments are still at a fairly nascent stage at the moment. Sure. So there are really two kinds of investments. Investments that can help you transform your business model, and investments that help make you more efficient, transform, if you will, your operating models. So at this stage, it's largely around ideation, but a recognition that we need safe and ethical uses of generative AI. But at the same time, what business leaders are telling me is that every model that's been produced of generative AI, that the next one is multiple times better. So we're recognizing the technology is amazing, and 72% of CEOs saying that it's a top priority for them from an investment perspective means that this is not hype. It's going to be a reality, that we are going to see increasing use cases of generative AI in many different industries. We think it'll be disruptive, and I think you see that reflected in the survey too, where many CEOs said it's a trend of disruption that they're going to have to pay close attention to.
When we talk about investments in AI, and we started to see this in the most recent quarters and earnings reports, it certainly has almost transitioned into a show me story. Investors, shareholders want to know how quickly it's going to impact the financials of the company. What did you learn, or have you learned there, just in terms of how quickly some of these companies that are investing or plan to invest in AI, when we'll see that return on investment?
I think most business leaders, CEOs, believe it's more of a 3 to 5 year horizon. And certainly there are going to be some near-term impacts, but 1 to 2 years out, there'll probably be somewhat meaningful impacts. But I think the real investments they're making will pay off in 3 to 5 years. And that's what the survey reflected. We certainly see a tremendous amount of investment in this space. We are investing with Microsoft, Google, Salesforce and others in this space, and we see our competition doing the same. And we also see co-development of solutions. So I think that will accelerate bringing those solutions to market as we put together some of our capabilities with the technology capabilities of these companies.
Well, I think at 3 different points during this show, we've talked about some of the disarray in Washington, D.C., and particularly what that spells out for a general election year in 2024. How are CEOs positioning themselves, their companies, and planning for what the reality of that may look like for their businesses, too?
Well, Brad, geopolitical risk and political uncertainty rose to the top of risks that CEOs are concerned about. There's compounding volatility right now, compounding risk in the market. We certainly as a business community are watching what's happening in Washington very closely. We're concerned about the trajectory of potential legislation in the future and how some of these situations, such as the speaker's situation in the House, the upcoming election, are going to affect not only legislation going forward, but shutdown risk around the government, because those risks are very, very significant to the economy. And so we as a business community are watching very closely what's going to happen and hoping that there is more alignment around progress and around the business agenda in Washington, D.C.
One of the points that you highlighted a few moments ago from the survey was deal-making activity, what you're seeing there, what companies or what CEOs are planning to do within that space. What are some of the top ideas that you're learning from in terms of where you're expecting to see some of that activity take place?
Well, what we know for a fact is that corporate balance sheets are really healthy. And we know for a fact that there is a lot of money in private equity firms and otherwise on the sideline ready to be invested, and many of them are still raising funds. So we know that once price discovery takes hold, once buyers and sellers come to a meeting of the minds around prices, and we start to get more stability in the leveraged finance markets, as well as ensuring we understand what the picture looks like for interest rates, whether they're going to increase any more, I think you'll start to see deal activity pick up sometime in 2024. A couple of the IPOs recently haven't been real successful, which initially we thought those were green shoots, and now we're having to kind of look at what's really happening in the market. But I think as we go into the end of this year and sometime into 2024, you'll start to see increasing deal activity, but probably not like what we saw in 2021 when the acceleration was really significant.
Paul, always a great conversation to get a pulse check of some of the CEOs, business leaders out there. Paul Knopp, who is the KPMG U.S. Chair and CEO, joining us here on set. Thanks so much.
Thanks for having me today.
Absolutely, great to see you. Well, cruise liners are the latest companies to warn of higher fuel costs, with Carnival warning of higher diesel costs weighing on earnings. Yahoo Finance's Inez Ferre has been keeping tabs on the growing list of companies impacted by a surge in fuel prices. Inez, great to see you.
Yeah, Brad, Carnival being one of the latest companies to recently warn about that surge in fuel prices of about 30% last quarter and how this will impact their bottom line this quarter. Now, it's important to watch certain types of fuels. When we talk about diesel, for example, that's used for cruise operators, it's used for delivery trucks, it's used for transportation and logistics. And the headwinds for diesel are there, definitely. You saw Russia, which had its export ban on diesel that would impact the global markets. You also have Saudi Arabia's voluntary oil cuts, and those are important because Saudi Arabia exports a heavier type of crude oil, which can be easily converted into diesel, easier than the lighter crude oil that the U.S. extracts. Meanwhile, jet fuel is also important because that has gone up last quarter as well. That powers commercial airlines, also airlines transportation for goods, taking goods rapidly from one place to another in the U.S. And we've seen that the major airlines, both international and domestic, have all warned about the higher fuel costs that they have encountered in the third quarter and how that will impact their performance. And then you've got heating oil. It's expected to be a cold winter coming up. And so you are going to see demand for heating oil go higher. What does this all mean for the consumer? Well, basically that these companies are going to have to increase their prices, whether it be directly for the consumer or increase their surcharges, because you do have logistics companies, for example, that have a surcharge on these higher fuel prices. We have seen oil going down in the last couple of days. I'm going to pull up the 2-year chart on our Wi-Fi Interactive. You're seeing Brent crude over the last couple of days going lower, and WTI. I'm going to pull up the 6-day chart. You can see down 7% over the last 6 days. Brent crude 10% over the last several days, guys.
And speaking of that, we see gas futures down here. Demand for gasoline is also down just a bit seasonally. What do you think this tells us just about the direction that we're headed and how we're seeing this balance between supply and demand?
Lower at the price pump, believe it or not. And this is because the EIA just came out with data about gasoline demand being seasonally lower than last year. In fact, gasoline demand is at its lowest seasonal level in 25 years. And then you've got the RBOB gasoline futures, which you can see here on our Wi-Fi Interactive. I'm going to pull up a 12-day chart, really falling off a cliff over the last 12 days. Now, you'll remember that in September, we saw the 2023 high prices for oil. So those are the highest prices of the year. And since then, you have been seeing a decline in gasoline. Now, Tom Closa of Opus says he believes that drivers are going to be paying about 25 cents to 50 cents less at the pump in many states. Now, you will recall that the saying goes that prices rocket higher and they feather lower. What he's saying is that these are wet feathers. He's saying, look, about half the states are already seeing gasoline prices at $3 per gallon. And he says it's a glacial pace, but it will be quite noticeable because of this lower demand that you are seeing. We're also going into the winter grade as we go forward, guys.
All right, Ines, thanks so much for that insight there. Keep right here for all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance.
Welcome back. You're watching Yahoo Finance Live. We're live from the Nasdaq market site in New York City. And as you all know, we're right in the heart of the city where some consider it a shopper's paradise, particularly around the holiday season, which is encroaching upon us. Yeah, holiday shopping is certainly in focus, and it appears to be going to another big level, at least according to data from Adobe Analytics, which is predicting that this holiday season shopping will be driven by buy now, pay later, and cyber weeks, with online sales hitting $221 billion US, a 4.8% growth year over year. All right, enough of us talking about it. Hear it straight from Adobe. Adobe Head of Digital Insights, Vivek Pandya, joins us now to give us more details on what we can expect from consumers this holiday season here. Vivek, how much am I expected to spend here? I mean, I'm sitting here thinking I'm going to be able to budget. I'm going to ball on a budget out here, but you're saying I'm going to spend more.
It's an interesting thing, Brad, because you're going to have a lot of different discounts coming your way that's likely going to entice you to spend more. And that's what we're seeing in terms of these holiday sales moments and how that's driving up spending. When you have discounts at this sort of level, it can entice consumers to purchase. The holiday season is that time period where they're really looking to get their gift giving done, and they're wanting to do it in a way where they can get maximum value and kind of manage cost.
Vivek, when it comes to some of the promotional activity, we know consumers have been relying on that pretty heavily, given the fact that they are facing a sticky inflation. What do you think that activity is going to look like, and how early are some of these deals going to start?
It's a great question that we've been profiling quite a bit in terms of the shape of the season in terms of discounting. So we're going to see discounts kick in as pretty heavily as early as next week with the Prime Day event. And what we're anticipating happening is those discounts kind of weakening after the event, after a lot of retailers have leveraged that day to get some early shopping from consumers. And then it'll really escalate, and we'll start to see discounts go as deep as about 20% starting in November 1st. And then we'll see the best absolute discounts kick in the weekend going into Thanksgiving week. And those discounts will be about as deep as 35%, and then they'll weaken to about 16% for the rest of the season. So discounts across the season, but really consumers are going to have to negotiate what the priority for them will be, whether it'll be early shopping or getting the best absolute discount possible.
Well, will discounting and the prices that are actually paid here for some of the products, the goods that are being sold over this holiday season, will that lead to a pricing reset? Because if we continue to have more people buying only at a promotional level, but then pushing back at full price, then where does that play into the strategy as we get into next year for some of the retailers that are thinking about the actual prices that consumers are willing to pay, even if something does look like full price?
Well, it's going to be dependent on different retailers and their position, their product set, and the demand levels they're seeing. But essentially, once we get out of the holiday season and into the new year, you're really seeing some of those discounting, these offerings start to subside, and you end up having consumers in a position where they're shopping for different types of goods, different types of things outside of the holiday season. And all those things kind of manifest into a new seasonal level of pricing for the new year. And I think what we'll be looking to see is what that means for other promotional days as we get to things like President's Day weekend, Labor Day weekend, Memorial Day weekend, all those sales discounts. We've seen consumers be very strategic in how they manage that. We'll have to see what the macroeconomic environment looks like for them in order to, and see how that affects their buying behaviors.
Vivek, we've been talking a lot about the buy now, pay later aspect, the fact that this is an option for consumers and the fact that many buyers are choosing this given the broader economy right now. What are you expecting to see activity for the buy now, pay later space? And I guess, what does that really tell us just about the strength or lack thereof of the consumer up until this point?
It's been a major part of our report. We're expecting about $17 billion to be spent online through buy now, pay later. That's about 17% growth year on year. So at a time where we're talking about more single digit growth, it's pretty stunning to see buy now, pay later really continuing to surge. And I think it's really indicative of where consumers are at right now, where you have some consumers who essentially kind of go through the cart checkout process online, and then they see that smaller payment option to kind of break it up into interest-free installment payments, and they're like, that seems like a good option. I'm going to go right for that. Pretty easy and straightforward. And then you have some types of consumers who are, in an economically challenged state, and they're trying to, get what they need for the holiday season. So then they're having to lean on that as a mode to drive growth. It really is describing essentially the macroeconomic environment that consumers are having to spend in, and how they're trying to manage and mitigate cost, but still get what they need for the season. So you have essentially a situation where we're seeing almost $221.8 billion for the season, but some of that is being subsidized by things like buy now, pay later.
Vivek, I'm sitting here on the edge of my cushioned bar stool waiting for the quarterly report on household debt and credit from the New York Fed. I'll have to sit here until November 7th for that, though. But as of right now, the data that we do have to go off of, household debt sitting at $17.06 trillion, and that's led by credit card balances right now. If we are there at this point in time and at this juncture after the holiday season, where are we expecting that to rise to, given the number of purchases that people are expecting, or at least some of the insights are expecting for households to make? And what does that say about the credit condition right now, or at least the credit that's being held as debt for many households right now that are going to swipe or tap to pay or do whatever just to get through the holiday season?
It's a great question in that, when we think about online retail goods and retail shopping, that's definitely one part of the equation in terms of the holiday season. And when consumers were coming into this holiday season this time last year, inflation was around 8%. Now we're coming in at just under 4%. So you have different forces impacting consumers at different levels throughout the course of the year and throughout the season. The holiday season ends up being one of those moments where consumers really try to stretch to try to, get the gifts they need for their family and friends. So we anticipate them, again, using things like buy now, pay later, spending what they need to, but trying to get maximum value in order to get to where they need to. As you mentioned, there's a lot of different factors informing that debt figure. So we'll have to see how that looks come January and what the economic situation looks like as we get into Q1. But I would say for the season, consumers are on this footing of trying to strategically buy so that they can, be able to get what they need while getting value, and not trying to put themselves in a more tougher financial position because of the prices of some of these goods.
Yeah, many consumers are budgeting this holiday season. All right, Vivek Pandya of Adobe, thanks so much for your insight.
Thank you.
Got all your market action ahead live from the Nasdaq market site. Stay tuned. You're watching Yahoo Finance. We're live from the Nasdaq market site in New York City. Let's talk the latest on AI. 64% of marketers saying that AI is important to their success in the next year, but more than half are still learning how to use the new technology. And only 7% say they have actually started scaling it. This is all according to a 2023 State of Marketing AI report. Now, one company, Drift, is already ahead of some of its competition. The conversational marketing technology firm has already put AI to use, unveiling a new suite of AI-powered products this week to further enhance the buyer experience. Joining us now, we want to bring in Scott Ernst. He's the CEO of Drift. Scott, it's good to see you. So talk to us just about the AI products and how you more specifically see AI revolutionizing your industry.
Yeah, thank you so much. Great to be here. So the significance of our launch this week is more about a product, more than a product launch. We've introduced an entirely new approach for B2B marketing, which brings us one step closer to curating the entire customer experience with the help of AI. Not for every business or every account, but for every human. And we're helping businesses deliver the right message. So AI is the only way to achieve this at scale. Drift is an AI-powered buyer engagement platform that listens, learns, and understands from buyers. And all three of our new announcements, these first-to-market announcements, help deliver on the promise of personal experiences for our customers and their buyers.
And so, Scott, where does artificial intelligence as a marketing function fit or sit most prominently in that funnel as you think about kind of that top of funnel and where you're just trying to make sure that you're approaching the right clients or at least generating awareness all the way down to the bottom of funnel where the sales teams can convert in a lead into an actual sale?
What a great question. It really applies to all stages of the funnel, right? From top of the funnel to bottom of the funnel. And we know when we see in the data that when you get a personalized experience, and this is from data from companies like Merkle or McKinsey, 76% of people will enter a buying transaction if they're delivered that personal experience. It makes the sales process faster, more efficient. So 25% faster time to cycle, time to deal by delivering these personal experiences. And you know what? End of funnel, end of the life cycle, Net Promoter Score goes up by 66%. So the key takeaway there is delivering these personalized experiences to your buyers at the right time delivers business results.
Hey, Scott, I'm curious. We were just talking to KPMG CEO earlier this hour. He was saying that AI is the top priority in terms of investment for companies this year. When you talk about your investment in AI and what it does here to help your clients, how quickly do you expect to see the return there on your investment?
Well, I think first, AI is changing how we all interact, how we work like nothing we've ever seen before. So we're putting a significant amount of our investment in taking the experience and the leverage that we've already built and applying AI across our full product set, right? So whether you're a first-time visitor to the site, we want to identify you and give you the right experience, or you're a customer coming back. So we expect to see dramatic returns in our own investments from what we're doing with AI.
What does a successful investment in AI actually look like? For a lot of companies, we've heard everything from AI to figure out the type of soda that we should be drinking, all the way to how it's going to be able to be a prompt engine for marketers to be able to use and perhaps put together a marketing automation cloud that much easier here. So what is the true marker of success here?
Yeah, so for us, it's increased pipeline, increased closed won business, and improved customer experience, right? Those are the three things that we look at. This year alone, we've delivered more than 30 million conversations for our customers. That's resulted in $12 billion of pipeline and $3 billion of closed won business. This has a significant impact on our customers' business, and our goal is to keep driving this train and keep moving AI and make it a part of all of our innovations going forward.
Scott, how do you see it affecting headcount, or do you?
So for us, it's not about replacing people. It's about enabling the workforce to unlock creativity. Again, this changes everything we do, how we interact. So we believe that this will be a net positive impact overall, again, in driving, unlocking creativity for workers. And if you think back to, if this is the fourth revolution, the intelligence revolution, every revolution before, the agricultural, industrial, computational revolution have all netted out at increased jobs and increased GDP. So we're optimistic that same kind of thing will happen here now in the fourth revolution.
Scott, while we have you, take us into drift as of this point. I mean, are we talking about a unicorn, decacorn type company? We know Vista Equity Partners had taken a stake in the company a couple years back. So all of this considered, where is the profitability netting out? What does that pathway look like towards sustained profitability and potentially maybe even an IPO one day? So we're interested in building an enduring, valuable company, right? That's our first goal. That's what we're chartered to do. When we do that, as we do that, we'll have opportunities and options for IPO, for other strategic opportunities that are case. We've got a great partner in Vista, and our expectation is to keep driving on the vision that we have for the company now, and great things will come, great options will be presented for us. All right, Scott Ernst, Drift CEO, joining us here today. Certainly look forward to checking back in the future, especially as you march towards potential IPO at a juncture at some point. We will check back in. A date to be determined. Hey, I have one final thought for you. Can I share one final thought with you? Right. So you got to go, but quick. Okay. All right. So do something now. My advice to all your viewers is start using AI now. Like however you do it, start playing with GPT. You got to be in it to win it. We're here to help you navigate that next frontier. Thank you very much. Look forward to staying in touch. All right, Scott, thanks so much. Appreciate it. Everyone, we're going to go to a quick break, but we've got all your markets action ahead live from the Nasdaq market side. Stay tuned. You're watching Yahoo Finance. Plugging into the latest electric vehicle news, Korean automaker Hyundai, like Sunday, they announced that they're going to adopt Tesla's charging plug, also known as the North American Charging Standard, starting in the fourth quarter of 2024. This is just the latest car company to make its vehicles compatible with the charging standard. It's a big win for Tesla. Its superchargers were once exclusive to owners of their own car, but recently started offering access to non-Tesla EV owners. And I mean, you really round out as we were kind of taking a look at some of those other major companies that have signed onto this new standard. It's been a significant way forward for Tesla here, but for GM, buy-in from some of the largest US as well as European manufacturers, that's certainly a way forward, at least perhaps providing some clarity as to where consumers who are opting into more electric vehicles can find a standard or make sure that their car is compatible with so many other chargers as well.
Yeah, and Brad, we know that the Tesla charging network certainly viewed as superior to the other options out there, some of those third-party players, just in terms of reliability and also just the availability of some of these charging stations right now. Just around 12,000 available here in the U.S., 45,000 worldwide. We put up the graphic of who has signed on and now makes it available there for their EVs or their future EVs in terms of their future plans. Two notable names, though, are missing from that graphic: Volkswagen and also Toyota. So certainly two notable holdouts that you would think, at least because of pressure, just because of obviously the fact that it's a little bit more easier, more accessible here in terms of charging stations. If they want to boost their EV sales, it would probably be a good idea in order to sign on there for Tesla. And also just a huge win for Tesla when you take into account what this could mean for their business in the longer term. All right, well, let's stick with Musk and pivot to another company that he owns, and that is X, formerly known as Twitter. It's removing news headlines from the platform. Now they are displaying a thumbnail image with a website link. Now, in August, Musk said that the changes would likely be coming, and also that he thought at least it would greatly improve the aesthetics of the website. This change initially caught me off guard. I think it's a little confusing. I actually don't disagree with Musk that in terms of aesthetic-wise, it is a little bit more pleasing. I think it will take a while for people to realize that there is the link in there in order to get to the news article and whatever is being posted, but it does clean it up just a bit.
Just as long as it doesn't still prompt me to read or at least say, have you read this article, when it's an article that I've written whenever I post it out there for our viewers to check out themselves as well. But I think all this considered, there's a few big changes that are going to continue to come at the platform X, formerly known as Twitter, especially under the helm of Elon Musk. The larger question is, what will the monetization be? What will that actually look like in converting some of these changes into core revenue drivers here? And I think for the user experience that they want to continue to lock in, how do you make the user experience more seamless and so that this can eventually be part of that everything app that X is supposed to or set to or marketed to be right now?
Yeah, certainly we've heard a number of ideas from Musk. He's floated a number of changes that we could potentially see on the app. He's followed through with some of those ideas. Others, at least, he's shelved for now. We know that's so important when it comes to ad spend. Musk obviously trying to diversify the business, but still very important to X, formerly known as Twitter, up until this point. There was also an interesting headline coming out yesterday, the anti-defamation leak, saying that it will resume spending on X after a temporary pause. Now, we know that this nonprofit had recommended back in November, just about a year ago, that brand advertisers pause their campaigns on X. So the fact that they are jumping in saying that they are going to be allocating more ad money, period, to X certainly may be indicative of some of the activity that we could see there down the line.
It's a big reversal, yeah.
It's a huge reversal. All right, well, let's do a quick check of the market. Just about 90 minutes into the trading day. We're still looking at pressure across the board. The Dow off just around 100 points. S&P off about 0.6%. Most of the pressure, though, that we're seeing today is from the Nasdaq's big tech names moving to the downside here. You have the Nasdaq off just about 1%. That does it for us today. We'll see you back tomorrow. Rochelle Akufo, Kiko Fujita have you for the next hour.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo with Akiko Fujita. Here's a look at what we're watching this morning. With a big jobs report on tap tomorrow, what should investors be expecting? We'll get a pulse check on the key economic data to come.
And oil prices may be pulling back, but ExxonMobil's profits certainly aren't. What the company's big boost means for the energy sector.
Plus, another antitrust crackdown on big tech, why UK regulators are launching a probe into Amazon and Microsoft's cloud services.
But first, let's take a look at where markets are trading right now. 90 minutes into the trading day, it feels like investors in a bit of a holding pattern as we anticipate that big jobs report out tomorrow. The Dow is down 130 points right now. The S&P 500 down 32 and the Nasdaq down 139. In terms of sectors we're watching, energy really the only one that's in the green, although just barely, trading flat right there. Bond yields also in focus today as we continue to see markets react to those yields pushing higher. We saw them move a little higher today initially on the back of weekly jobless claims. They did tick a little higher, but came in lower than the street was expecting. The 10-year yield right now, though, at 4.73. Well, long bonds are sinking at historic levels that rival the dot-com bubble burst, slumping 46% since peaking in March 2020. That's at least according to Bloomberg. We've got jobs data on deck tomorrow that could have a major impact on the market. Joining us now with her insights is Michelle Schneider, MarketGauge.com chief strategist. Michelle, good to talk to you today. So, it's sort of kind of moving in the direction of good news is not necessarily good news for the market. If that jobs number comes in stronger than expected tomorrow, how high do yields move?
Well, it's so interesting because if you want to get some clues, so far, right, ADP payroll was weaker, but it still was jobs added. And of course, what we saw today was basically in the range that we've been seeing between 200 and 250. So it tells me that most likely, if we see any tick up in unemployment, it may not be enough to really give the Fed reasons to change the course that they've been so clear that they're doing right now, which of course is keeping rates higher for longer. So there could be a surprise, absolutely. What's so interesting about the market right now, Kiko, is that we have our risk gauges, which measure ratios between things like junk bonds and long bonds and the SPY and the long bonds, still saying risk on even with this sell-off. So maybe they're suggesting the surprise here. Maybe it's because utilities are so interest rate sensitive. But overall, I think we have to be extremely cautious considering the inside sectors that we like to watch, which would be transportation, small caps, and retail, are sitting on a very critical line in the sand that if they break further from here suggests recession, which of course then at some point would probably be reflected in jobs.
So then, Michelle, is a stock sell-off basically the only way to tame this bond rout that we're seeing?
Well, possibly. I started thinking this morning, Rochelle, about how do you find a needle in a haystack? And what you have to do is you have to burn all the hay. And so maybe that is exactly what has to happen. We hope not, of course, because it's very damaging. But this is the reason why you have so many different calls, from a seasonality call of pre-election year, market's going to make new highs, because anticipation is the Fed will have to relax at some point and not be so afraid of the goose of inflation. And then, of course, you have the camp that thinks, yeah, we've got to burn the house down and then see what needles are left. It's really hard to know right here. So I think we have to be a bit more patient.
Which camp are you in, Michelle?
Right now, a gun to head, I would say that unless there's some kind of real capitulation in the bond market, and the best I can say is if we look at the long bonds, the range of the last 2 days are within the range of when it made that big dump on Tuesday. So we're still holding there, which means maybe it could reverse. The dollar certainly has softened. Other than that, I would have to say, looking at the small caps, they look like they are burning right now. So I would be more on the downside than the upside this moment in time.
So then, Michelle, obviously we're in a higher for longer interest rate environment, still seeing bonds thriving at the moment. I mean, having that bond rout. Who gets stung the most? What kinds of investors, based on the inflows that you're seeing, are going to get stung the most here?
Well, people who don't know anything about trading commodities, which I'd love to talk about for a moment, but to answer your question, I think those that have really been sold two things. Number one is growth stocks will always do well no matter what. Relatively, yes, but we know that they can fall under the pressure in terms of that big crocodile chart that you're seeing, the spread between growth and small caps with the jaws so wide. If small caps fall, we know the top jaw is going to have to fall as well. And the others who feel like we can do, a dollar down averaging, just keep buying dips. Because if we go into not recession, but stagflation, the market may not necessarily crash so much, but it may take years, possibly 2, 3 or more years for those numbers to come back in terms of those growth stocks and even the dividend bearing stocks. You have to realize at what point are your dividends taking control of your life as opposed to watching the stock go down. So the people who are passive investors always have the most to lose. And that's why we always try to educate people on having some kind of a risk parameter in their portfolio.
So, Michelle, let's talk strategy where you're putting your risk on there. Transportation, one sector you're looking at right now. I'm curious what part you find opportunities in, because that's one, especially among car makers, we've been talking a lot about with the UAW strike, with the transition we're seeing to EVs. Is that the area where you're increasing exposure?
Well, again, everything, if we have some kind of a liquidity crisis, is going to fall, including EVs, especially if it's more recessionary than stagflationary, because people will not necessarily go out and buy EVs and production can get halted. And right now, it's interesting that you mentioned the strike, because in terms of investing, we're very, very light. I look at the transportation IYT because it actually has been outperforming versus, let's say, the retail or the small caps. But that doesn't mean that outperforming is great performance. And the rally we've seen recently in Rivian and Tesla, again, has gone up, but into resistance, not really wowing us yet. So I'm looking at, in terms of investments right now, I have waited for this correction in a lot of the commodities, the soft commodities, natural gas being really big on my list, things that have to do with supply disruption. This strike to me is a potential indication that unrest could increase here with so many issues that we have in this country, besides higher prices and higher interest rates and strikes and theft and government that seemingly is not necessarily engendering confidence. This tells me more of the stagflation is really what we prepare for. And if that's the case, you want to look at some of those commodities as investments, possibly looking into the ags or DBA or natural gas or UNG, or some of the companies that deal with delivery, like TK would be one, or Scorpio Tankers. They are holding up in this environment so far.
Certainly a confluence of issues the American economy facing here. Appreciate you taking the time to join us this morning. Michelle Schneider, MarketGauge.com Chief Strategist. Thank you as always. Well, speaking of commodities, looking at oil prices continuing declines from Wednesday's session as fears around demand destruction seep into the market. Joining us now with more is our very own Inez Ferrer. Inez, what are you watching?
Yeah, Rochelle, definitely demand destruction really seeping into the markets right now. And we saw that with the JP Morgan note yesterday. We've also been seeing it with prices. I can't bring up my interactive right now because it's frozen, but you can pull up the screen there so you can see that WTI right now is trading at about $83.50 per barrel. That's about $10 off of its 2023 highs about a week ago. Brent crude also trading about $10 lower from its 2022 high. Some important data has come out recently. The EIA saying that gasoline demand in the U.S. is at its lowest seasonal level in 25 years. So you are seeing that those higher gas prices that we saw earlier in around August, September, that those are steadily coming down. And part of that is just demand destruction happening. Also, Saudi Arabia and Russia saying that they will continue with their supply cuts through the end of the year. RBC Capital says that it believes that Saudi Arabia could continue continue with its unilateral cuts into 2024. That tells you something about Saudi Arabia wanting prices to be above a certain level, but it also tells you something about where they see demand going forward. And RBC Capital, by the way, is the same firm where the analyst said that you could see oil going to $100 a barrel if momentum continues this way, because they say that the markets tend to overshoot and then they tend to overcorrect. So we may be seeing a little bit of that now as well, guys.
Yeah, 2024, quite a long projection there. Inez Ferre, as always, thanks so much for that.
Thank you.
Well, we are watching shares of Alstom sinking today, more than 26% after half-year results show the French train manufacturer saw free cash flow fall from negative 45 million euros to negative 1.15 billion euros. The company is on course for its worst trading day in at least 20 years, according to London Stock Exchange data. And Rochelle, some of that, the company pinning on delays that they saw, particularly in the U.S., well, Europe included as well. Some of those payments getting pushed back on these large contracts, and the company pinning some of the blame on that as well.
It's true. I mean, also for the full year, looking at the free cash flow estimates, now in the range of negative 500 to 750 million. They were supposed to be originally forecast at being significantly positive. So really having that sort of turnaround, stunning investors at the moment. And I mean, a number of issues at stake here. I mean, you mentioned the UK contract, that they had some issues also with a rise in inventories. They also had a rocky acquisition of Canadian manufacturer Bombardier. And then when they were asked about divestment, CFO Bernard Delpy said, if there are good opportunities, of course, I will discuss it with the board. So a lot of uncertainty here, especially in that full-year guidance, really shaking investors there.
Yeah, and a steep decline today on the back of that as well.
Indeed. All right, well, we have more of your markets action ahead. Stay tuned. You're watching Yahoo Finance. Back in 2019, FTX was just a startup and within a few years was valued at over $30 billion, dominating the crypto space as one of the largest cryptocurrency exchanges in the world. Meanwhile, fast forward to 2023, the face of the company, Sam Bankman-Fried, facing criminal charges that could sentence him to a lifetime in jail, and his company is bankrupt. On Wednesday, the jury selection was completed, opening arguments were given, and the prosecution started by laying the groundwork and taking 2 witness testimonies. Now, this is very interesting because a lot of the discussions really come down to intent and how Sam Bankman-Fried is being painted. When you look at the prosecution, Nathan Wren is saying, really framing this as being a very calculating person, saying that he was using allegedly these investor deposits for his own personal use, as well as speculative trading via Alameda Research, the FTX-affiliated hedge fund. Basically saying he lied to the world, committing a massive fraud, taking billions of dollars from thousands of victims. Meanwhile, defense attorney Mark Cohn really framing SBF as being, essentially a tech nerd who sort of got in over his head, saying, Sam works very hard, didn't drink or party, didn't try to defraud anyone, saying there was no theft, and really chalking a lot of the losses that came from FTX as really par for the course of what was happening with crypto itself at the time, sort of the sell-off that we'd seen as well as the crypto winter, and really trying to paint this as not being an intentional defrauding of investors here, Akiko.
Yeah, we're now on day 3 of this trial, expected to last about 6 weeks. So still in the very early phases. But to your point, what we have heard from prosecution as well as the defense, some very familiar arguments that we heard in the lead up to this case. You talked about how the prosecution came out. They specifically called the FTX a house of cards, a massive fraud. And that really is the sort of the thread in the prosecution's case. An interesting article out from the Wall Street Journal this morning that seems to point to what the prosecution sees specifically as, what some would argue, a smoking gun, a backdoor that was created between FTX and what you just mentioned, Alameda Research, that allowed FTX to tap into the funds there. And that's really at the heart of this argument from the prosecution, saying specifically that Sam Bankman-Fried used customer funds for his own personal benefit. It's going to be an interesting trial here as we continue to follow it. Certainly going to be a lot of talk about his former CEO of Alameda Research, also his former girlfriend, Caroline Ellison, seen as a key witness here for the prosecution. A number of stories already coming out because of the Michael Lewis book as well. But there's going to be some really familiar faces because it was a pretty tight-knit circle there at the very top at FTX.
Indeed.
Well, for almost a year now, artificial intelligence has taken the world by storm with the initial launch of ChatGPT to the technology becoming the new it word of earnings. In September, however, we saw the first steps by the U.S. government to regulate the emerging technology, and it may be that it works in favor of big tech. Let's bring in Yahoo Finance's Dan Halley to give us more details. Dan.
That's right, Akiko. We're seeing more tech companies come forward saying that they want the U.S. government to regulate them. And it's kind of an odd statement for them to make. Why would they want to be regulated when they can basically just have a free-for-all right now? Well, there's a few reasons. The first of which is they want to make sure that what they're putting together doesn't eventually get regulated out of existence. Basically, if what they're trying to do is create new types of technologies, they're investing billions of dollars. If new regulation comes in and says, well, you can't do that because of XYZ reasons, then they've just wasted billions of dollars. So that's part of it. The other is that it gives them a seat at the table when it comes to kind of putting these rules together. They'll come out and say, we want this regulation, but maybe we should do it this way. And it'll allow them to have at least some kind of say. The closer they are to it, the better. There's also the idea that they would have a singular rule that they would have to deal with rather than a patchwork of rules across the 50 states. And so that's something that we currently see with the privacy laws. For the U.S., there are a number of different laws for each area of the country, different states, and it makes it difficult for companies to kind of understand where they're coming from. And then finally, it helps with consumers and ultimately their customers decide if they actually want to buy into these types of AI. One expert I spoke to likened it to a doctor prescribing a medicine that's approved by the FDA. Well, it has the full backing of the FDA, so they can be confident knowing that it will be a type of medicine that will help their patients. And that's kind of the same idea, although think it's illegal to prescribe anything that's not approved by the FDA, but it's the same kind of thinking where these customers, big businesses, are more likely to purchase some kind of AI technology from these companies if it's got the full backing of the federal government and it meets certain regulations. So there's a number of reasons why these companies are doing it. We just have to see if it actually happens.
Indeed. I mean, these tech companies are essentially the ones pushing a lot of this technology forward. And then when you keep in mind also, when you look at AI, it's something that's borderless, essentially. So how does that work with perhaps international markets? You know, the EU is always taking an eagle eye on issues like this. How will this all then work together if you have the US government trying to sort of push its own AI agenda here for tech companies, but a lot of these are multinational tech companies?
Yeah, I mean, it comes down to what each area wants. China pushed forward its own guidelines for AI. They're implementing those. They're going to be different than what the EU is looking to do. They're trying to introduce the AI Act by the end of this year. And so what they would do is put up different regulations based on the risk factors of the different types of AI that are available. And so that's going to differ from what China's doing. And then the US may have something different as well. And really what it comes down to is how big are these areas? How can they easily put together regulations that meet criteria for them without having to double up or triple up. And so, you know, where we saw the EU put together privacy laws, they've, you know, you'll see some questions about whether you want a website to access your data on, you know, the web. That's coming from California, which took off of the EU. You know, if you went to China, though, you can't access some of the apps that we have here. So I think it just comes down to how these companies will be able to calculate risks per region. I think at this point for the US, it's just, sure, we can do whatever we want. We just want to make sure that we don't sully our name with a bad product.
Okay, well, we'll see how it all shakes down there with a heavy push from these tech companies. Dan Halley, as always, thanks so much for that. Well, all your markets action straight ahead. Stay tuned. You are watching Yahoo Finance Live.
No relief in sight in the housing market. Zillow says home buyers' budgets are now stretched to the breaking point. Yahoo Finance's Danny Romero has that breakdown for us. Danny, what can you tell us?
Rochelle, competition in the housing market is cooling down, but this cool down is a lot more noticeable than previous years. Zillow says mortgage rates are really the blame here, the main driver of what's causing this. The average 30-year fixed mortgage rate has hovered over 7% for over a month now, 6 weeks. And as a result, monthly payments for buyers reached $1,896 in August. But what's more shocking about all of this is that the principal and interest to buy a home right now has increased 122% in the past 3 years. And it's really unlikely that interest rates will come down and mortgage rates will come down in a meaningful way. The Federal Reserve has sent the message that interest rates will stay higher for longer. But there is a positive side to this whole equation, and that is on the supply side. There's been an improvement there's been an improvement in new listings according to Zillow, but that's really a pulse, not a wave. So that could mean that sellers just couldn't wait and delay the process of selling their home in August due to some life circumstances, which really causes to sell a home. But again, affordability is still the main challenge when it comes to home buying.
Yeah, Danny, it feels like kind of a broken record month on month, right? When we're talking about what the reality in the housing market is right now, what does that sweet spot look like for buyers, and what's the timeline?
Zillow says that there is a sweet spot on the horizon, and that really comes from the supply side. Zillow reported that there's been a high month-to-month increase for new listings in August. And so sellers seem to be more willing to lower the price right now. And that could be the reason is that some sellers are just getting really anxious that they miss the summer window when it comes to selling their home. And there's a little bit more demand when it comes to the summer months. And so that really brings an opportunity for buyers who have that wiggle room in their budget to accommodate for these higher interest rates. We've also heard too on the ground that cash buyers are really winning the game right now. So that's something that I continue to hear even on across all regions right now from real estate agents. But another thing that really stood out to me is that there's a lot of motivated and active sellers right now since last December. So there really is some accommodation on the buyer side and when it comes to buying this home.
Got to try some way to get that house, right, Danny, if you're in the market right now. Danny Romero, as always, keeping us up to date on the housing market. Well, low inventory is pushing many home buyers towards new homes, but the growth in new construction isn't necessarily enough to narrow the inventory gap. According to a new report from Realtor.com, home prices saw a surprising uptick in price-reduced homes from August to September amid ongoing affordability concerns. Let's bring in Danielle Hale, Realtor.com chief economist, to discuss. Danielle, tell me there is some good news on the horizon.
Yeah, there is some good news on the horizon. I mean, as Danny was just talking about, the uptick in newly listed homes, we saw that in our data in August. I'm going to temper that good news a little bit, which is to say it seems to be a short-lived August phenomenon. In today's data out on September, we saw that new listings trend kind of returned to its normal pattern. So we're still not seeing enough sellers in the market. But there is some good news for buyers, which is in the midst of what is a very challenging housing market environment. This week, from October 1st to October 7th, is the best time to buy. So even though these big macro conditions are challenging, mortgage rates are high, home prices are high, if you look throughout the calendar year and you need to make a move now, this week gives you the best sort of combination of still available housing inventory with slower prices, somewhat more price reductions from sellers who are motivated, who want to sell before the end of the year, before the housing market really slows down for the winter. And so that's really creating a bit of a break amid a challenging situation for potential buyers.
So it sounds like a lot of this is more about seasonality versus, sellers just sort of pricing to be competitive as with just seeing house prices go down. So then in terms of a light at the end of the tunnel here, what is motivating sellers beyond some of these seasonal changes? Is it the pinch of inflation or baby boomers downsizing? What are some of the demographics here?
Yeah, so looking at best time to buy is really all about seasonality because that's very predictable in the housing market. The thing that has become abundantly clear is very difficult to predict is these mortgage rate trends and like these broader macroeconomic trends. We're seeing mortgage rates reach new highs when most forecasts heading into 2023 expected that we'd be past the peak of mortgage rates at this point and seeing them start to decline towards the end of the year. So taking advantage of these seasonal trends, which are much more predictable, I think is something that buyers can keep in mind. When we think about what's motivating sellers, we identified two potential causes of that temporary, or what has shown to be somewhat of a temporary uptick in August. And that was that, potential sellers were looking at the mortgage rate trends, seeing the mortgage rates start to increase in September and kind of thinking, well, I've been waiting, maybe I should jump into the housing market before mortgage rates go even higher and buying conditions kind of deteriorate further for buyers. So that was one potential driver. The other is that people are just acclimating to this higher rate environment. And so if they put off plans waiting for mortgage rates to fall, maybe they decided it's not time to wait any longer. I just need to move ahead, and I'm just going to have to deal with the current mortgage environment as it is. And so I think it's a little bit of both factors. It might be more of the temporary thing, which explains the 1 month uptick, and now we're sort of going back to what was the previous trend. But I think as we see time progress, more and more homeowners will acclimate to these higher rates and just set their expectations accordingly and move ahead with what they need to do in the housing market.
Danielle, if you're a buyer in the market, you've certainly accepted that rates are higher. There's an interesting Wall Street Journal story out today, though, that talks about how that range of rates are increasingly widening. And I'm curious if you're seeing lenders really price their loans more aggressively now, knowing the limited number of buyers that are in the market. What are you seeing on that side?
I think absolutely with lower volumes in the market, there are fewer transactions, fewer buyers out there. Lenders do have to price competitively. So it has always paid to shop around for a mortgage. And I think that's even more so in this kind of rate environment. And as a buyer, there are things that you can do to improve the mortgage rate that you as an individual are going to get. Make sure that your credit score is high. Take a look and clear up any potential issues. Make sure you're in a good financial position, so you've got a significant down payment savings. It would be worth talking with a lender about the particular loan products that are available. You might, for example, do better with an FHA loan as opposed to a conventional loan, or if you're eligible for it, a VA loan as opposed to a conventional loan. So exploring the different products that are out there, and also maybe playing with your down payment, so that in some cases, if you put a higher down payment, in some cases, maybe if you put a lower down payment, you might actually see the rate scenario change. So working through those scenarios with your lender can help ensure that you're getting the best rate possible.
And if this is the best time to buy, in terms of regions or metro cities, where can people get the most bang for their buck right now?
Yeah, so we're seeing the housing market remain relatively competitive in the Northeast and the Midwest, not necessarily the biggest cities in the Northeast, but in a lot of sort of the close-in suburbs and secondary markets that are within not too distant of New York and Boston. Those are areas that have a very high center of gravity right now. We're seeing homes continue to sell relatively quickly in those markets, and prices remain relatively elevated. So those are good places where buyers are looking for affordability on a relative basis and finding it. And we're seeing the housing market reflect those trends.
All right, people have to do a little digging there. Danielle Hale, Realtor.com's chief economist, thank you so much for joining us this morning.
Absolutely.
Well, the love for hybrid cars might be seeing a new surge in popularity as pricing and weak charging infrastructure appears to be deterring consumers from purchasing fully electric vehicles. According to data from Global Data, US hybrid sales have more than doubled since 2020, seeing a 35% increase in the past year alone. And hybrids have also continued to outsell EVs in the US, approaching 1.4 million vehicles in 2023, commanding 9% of the car market compared to the 1.2 million in electric vehicle sales, and control over 8% of the market. But are hybrid cars truly more cost-effective than fully electric vehicles? Well, the Idaho National Lab has found that even though hybrid cars are more expensive initially due to the need for a larger battery pack, they are economical, saving owners long-term on fuel costs. Now, Kiko, I know you're an EV person here. I'm one of these people who's sort of been teetering on the edge here, debating whether or not I'll go sort of the plug-in hybrid, or the traditional hybrid that sort of charges as you go, or just sort of biting the bullet and going full EV. When you think of between the tax breaks and some of the benefits, it makes sense that people want to hedge their bets and go for a hybrid.
Yeah, because you get the best of both worlds right now, right? I mean, the range anxiety is real. It's not necessarily that these EVs don't have the range, they do. It's that the infrastructure just isn't there. And unless you're driving a Tesla, which has really a very reliable network, it's just tough to make that switch for a lot of drivers. To your point, when you're talking about plug-in hybrids, at least, they do still qualify for that $7,500 IRA tax credit. So interesting bet there in terms of where drivers are going. I mean, that also points to just how drivers are still thinking a little more long term. I mean, EVs are where the market's going, but when you think about where fuel prices have been, still painful to go for an ICE car completely. Plug-in hybrid seems to be a good compromise, at least for drivers who are looking to save a little money right now.
It's true, and you kind of have to balance it because you also sometimes will get charged more in terms of car insurance because, you know, EVs and hybrids, it's more expensive to fix. And so it's trying to, you know, balance some of these considerations while you're trying to, you know, balance your checkbook, balance your wallet in a high interest rate environment. So a lot to consider. I'm still leaning towards a plug-in hybrid. I'll keep you posted.
Yeah, I mean, maintenance costs, though, are almost non-existent when you think about EVs compared to an ICE car. So there's that benefit as well. But it really, at the end of the day, it is a comfort level. And the reality is the infrastructure just hasn't followed yet, at least for 100% electric vehicles. Well, we've got all your markets action ahead. Stay tuned. You are watching Yahoo Finance Live. The auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers in our special series, EVs, The Road Ahead. It all starts on October 9th, right here on Yahoo Finance. Well, Amazon and Microsoft are in the hot seat after UK regulators launch an investigation into the tech giant's cloud services. The investigation comes after a study from Ofcom brought to life concerns about the ability for customers to use multiple suppliers. And we should mention, for those who aren't familiar, Ofcom is UK's communication regulator. This should not come as a surprise necessarily, because Ofcom's been looking into the dominance that Amazon and Microsoft have had on cloud services for a year now. And this push for an investigation is the result of that investigation that preceded it. Now, this number, I think, Rochelle, is worth pointing out and points to why there are concerns. When you look at Amazon Web Services, Microsoft's Azure combined, they have 70 to 80% of the market. And the concern is that they lock customers in and make it more difficult to customers to get out of that particular ecosystem. So something that they are under investigation for in the UK. There's another investigation in Japan. There's an investigation in the Netherlands, France, not necessarily limited to the UK, but it points to where the regulation spotlight is being shined on right now.
It's true, and obviously because they make up the biggest share here, they got most of the spotlight, but this does speak to broader concerns that they have in the UK about the dominance of some of these companies. And as you mentioned here, it's about being able to switch, being difficult for customers to switch, being difficult for them to be able to use multiple suppliers, and also talking about some of the software licensing practices of these cloud providers. So even though Amazon and Microsoft in the crosshairs here, certainly not the only ones that UK regulators are focusing on here, Akiko.
Yeah, Google just close behind, where actually I should say they're not that close behind. They are third in terms of market share, but just 5 to 10%. So that shows you the dominance from Amazon and Microsoft as well. You know, we always look to the UK as well as the EU as a potential template, a sign of things to come in the US, because they have tended to really lead on regulation, especially around tech. But certainly a story to follow here, because no question regulators here in the US are also watching this space and investigating it closely.
Yeah, I'm sure the FTC will be keeping an eye on what's happening out there as well. All right, well, shifting gears here. In an uncertain environment, how should you plan out your financial future? Well, investing and savings platform Acorns is looking to boost financial education and money management through its new premium offering. Seth Wander, Acorns CFO and CIO, joins us now to discuss this more. Good to have you on the show here, Seth. So talk about the timing of this and what you're really hoping to achieve by adding this new feature here.
Yeah, well, thanks for having me. Well, October is financial planning month. And so with our new premium tier, we wanted to make sure that we had an offering that allows for not just individuals to think about financial planning on their future, but to really start helping the family, both parents and kids starting from the age of 6 and onwards, really being able to think about what it means to, earn money, to save money, to stay on budget, to plan for their future, to invest accordingly. And so the tools and experiences that we acquired with GoHenry earlier this year really help parents start that onboarding process to make kids much smarter with planning for their financial future and build those money habits earlier in life. And we all know that the habits we build early on, particularly the good habits, tend to stay with us for our lifetime. And so we really want to help families start that journey today.
Seth, clearly this is about long-term planning. So we're not talking about, really tapping into the funds now, but you've got a pretty good pulse on where that financial planning is right now, at least the thought process. We've heard more and more that Americans are maybe not saving up as much or having to tap into their savings as well. From your vantage point, what are you seeing?
It's interesting. So I'm glad you asked it that way. I've got 3 kids from 9 to 13, and I've done several events at my kids' schools talking to kids about how do they think about money and how do they think about planning. And a lot of them have not even started that conversation. And if you think about today's millennials, 70% of them keep their money in cash and they don't invest and have the opportunity for growth in the future. And so it would be great to have the younger generation of kids as they grow up really build those skills from an early age. We do see that people in the general markets are nervous about investing, and you can see that through the money flows as people have put more of their cash in money market accounts than the equity markets at the moment. But when you think about the long-term investing and the power of compounding, there is indisputable math. If you look at the history of the S&P 500, that the benefit of compounding from that market return far outweighs the interest that you would get or the interest income you would get from just having your money in cash. And so we want to be able to teach both families and kids the idea that it is important to save, but it is also important to allocate your money purposefully, both from, let's say, an emergency savings to all the way through staying on budget, and then having, whether it be for college or your future, certainly your retirement, and then a general investment account. And so we're pushing that education and that experience through the whole family with our premium tier.
And so I was wondering, what will be your competitive edge here? I mean, there's a million financial educators out there. You have these fintech and financial influencers all over the place giving sometimes questionable advice here. How do you stand out from here? Because when I remember Acorns, it was about sort of squirreling away those little bits, when you had sort of leftover, when you would swipe your card and have a little money in there. How do you then evolve it from here to really break through the noise?
Yeah, there's a few different angles to that. So first of all, if you look at GoHenry, they've been an award-winning app for many years now in terms of the quality of their education. Specifically in that experience, there are money missions which allow kids and teens to learn bit by bit on various pieces of their financial needs. And so we think we can separate ourselves with the quality of the education that we offer. If you think about from an Acorns perspective, you're right. We built our brand off of roundups and the ability to invest in the long-term compounding of the market. But we've done it in a brand-focused way where people really feel that we're a trusted advisor for them and allow them to take the appropriate risk for wherever their life stage is and what their suitability is. And we will continue to do that. And then the last piece of it is making it simple. People want to feel that they're doing the right thing. They want to understand why the decisions that they're making are so and are right. And so between education and the brand, that goes a long way for people. But it has to be simple, and I think we've nailed that. And so the combination of all three is really where we separate ourselves versus the noise and the other opportunities that might exist out there for people.
So Seth, going back to my earlier question, though, are you finding, particularly in such an uncertain environment, at least when you look at the broader economy right now, are you finding that your clients are sort of stashing away more sort of for the long term? I mean, how is this kind of affecting behavior, at least within Acorns, within your clients? What are you advising them?
Yeah, so for our customers specifically, the nice thing for us that we see is that touching upon the education point, we've really taught our customer base that when you invest for the long term, there will be periods of time where the market goes up a lot and it's nice to be invested, but there will always be bumpy periods where the market goes down. And by investing consistently over time, you're able to buy more of shares in the market when the prices go down. This year the market's been up a fair amount, even with the latest pullback. What we see in our investor base is people really follow our way of investing, where capital inflows far outweigh any other choice of options people have for their money. And so we continue to see more money come into the market. The nice thing about that is that you see the stickiness of our customer base really understand that the long-term investing and the compounded return of that will make a difference in their financial future. What we're talking about here today from our premium tier and how we want to think about that with GoHenry by Acorns is really being able to take those learning lessons, the behaviors that we see from our customer base today, and teach that to the younger generation so that when they grow up, they continue to look at it from the same lens. So I feel good about how our customers are behaving today. They are following the tools that we provided to them and the education in terms of understanding the long-term trends in the market. And we want to broaden that for families holistically.
I love that. That consistency is key. I mean, it might be tough to get my 10-year-old excited about, retirement, but I'll try to sell her on it. And obviously, if they see the path forward here as this long-term, savings option, I think it's fantastic. Great stuff there. Thank you so much, Seth Wonder, Acorns CFO and CIO. Thanks so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
The auto industry is facing its biggest transformation in decades, electrification. And it's not just Tesla shaking things up. The ripple effects are being felt from the factory floor to the driver's seat. And it hasn't been a smooth ride between supply shortages, the auto worker strike, and high prices. The road to broader adoption is filled with speed bumps. Yahoo Finance has the manual on the top issues facing the industry for both investors and drivers. in our special series, EVs, the road ahead. It all starts on October 9th, right here on Yahoo Finance. We saw a big split in the food space earlier this week with Kellanova taking over popular snack brands like Pringles and Cheez-Its and moving cereal brands like Frosted Flakes under the WK Kellogg umbrella. And WK Kellogg CEO Gary Pilnick spoke to Yahoo Finance, saying this is a new beginning. Let's bring in Brooke DePalma, who joins us with the details. Kellanova, I can't get used to that.
It definitely doesn't roll off the tongue like Kellogg's does. But I did speak to WK Kellogg, another one that doesn't quite yet roll off the tongue just yet, CEO the other day following this spinoff. And he really is determined to take Frosted Flakes, to take other cereal brands that everyone knows and loves into the future. And really, when you think about what these brands entail, they're ones that we see on the shelves, ones that many of us grow up with. They include Fruit Loops, Kellogg's, Apple Jacks, Rice Krispies, Raisin Bran, as well as a few others. And really, Gary Pilnick here really determined once again to take this 117-year-old company, what he calls now a startup because of the spin, into the future. And he broke it down into 3 different horizons that he's looking at to really grow this company. He said in the first 3 years, the company plans to optimize that core cereal business. He said the company is investing $450 to $500 million in the company's supply chain and intends to move forward with lessons learned after that 3-month-long strike back in 2021, as well as that fire out of its Memphis plant back in 2021. But after those 3 years, he said the company plans to move beyond cereal and is certainly looking at innovation as consumer snacking habits continue to evolve. And in addition to that, he said that the company is open and looking to M&A targets where they would be a natural parent. He said they want to bring incremental value by being the owner of that business, but also finding cost synergies and driving revenue. And so definitely a lot of eyes on what exactly this spinoff or rollout to be.
And speaking of those eyes, I mean, I know we've talked a lot about, the snacking economy, how it's still holding strong. What's Wall Street's reaction been to this?
Yeah, well, really the spinoff happened so that this North America cereal business can be hunkered down on, I guess you could say. But as you see today, shares down nearly 7.5% for WK Kellogg. And Wall Street isn't quite yet sold on this strategy that the company is laying out. Just 4 analysts initiated coverage so far. And in the early innings, we're hearing from analysts that, there's lots to be said, lots to be done. Morningstar weighing in a note to clients saying that WK Kellogg shouldn't be so quick to jump into other categories. This was intended to focus on that cereal business, and so the focus should have remained there. Goldman Sachs also weighing in, saying that we see near-term margin expansion potential, unfavorable input costs, but they are keeping their eyes on that 5-year contract renewal set to happen in 2026. That once again, there was a strike back in 2021, that 5-year contract set to expire in 2026. But when I asked the CEO what exactly his message is to investors, he honed in that there's a unique opportunity here. They are a 117-year-old company that he sees now as a startup, and they're not too focused or running operations day to day based upon the stock's reaction. So certainly lots to watch as this continues to unfold.
Yeah, a lot of changes there, changing to a startup mentality. Brooke DePalma, always on top of the food space for us. Thanks so much for that. Let's do a final check of the markets before we let you go. Heading into the noon session right now, we've got red arrows across the board. The Nasdaq, the biggest loser on the day, coming off of session lows, though, down about 90 points there. The market's certainly going to be looking for that big jobs number out tomorrow. We'll be keeping a close watch on Treasury yields on the back of that as well, with the 10-year right now at 4.7%. That's it for now. I'm Akiko Fujita along with Rochelle Akufo. We'll be right back here again tomorrow at 11 a.m. Eastern. See you then.